idea, right? So all these things we covered. So any confusion around any of the topics, any of the topic that we covered in the last chapter? Anything not clear? You can ask anything if in case you feel like there's some more explanation needed, or if you're comfortable, then it is fine. Uh, so from your point of view, so I would give you. So anyone who has completed the assessment attached to the chapters, are we completing our assessment?
Yes, sir. I have started.
Okay.
Couple of slides I have completed.
Okay, fair enough. So, and also at the same time, there are a lot of videos available on each chapter.
Yes,
So
sir.
if you,
Even going through the videos also at the same time.
okay, okay. So at your convenience, like, so you can probably go through those videos. If you find them useful, you can probably spend time there also. And at the same time, we cover that stuff which is there in the form of video with the presentation and all. So even when you come across any questions while we are discussing on the presentation, then it is fine. So that is how it is. That is how it is, right? So so let us okay. So any confusion about the kind of preferred stocks we have? So all of them is fine, right?
I
Any
have a
doubt
question.
on? Yeah,
Yes, sir. Am I audible?
yeah, you are audible. Go ahead. Now audible.
Sir, we have studied quite a different instruments in equity market, but uh, can we say that in future can we add crypto also in these markets?
Okay, very nice point.
Is there any
So
proposition for that?
yeah, that's a very valid point and very talked about nowadays, because crypto, by having this cryptocurrency, and a lot of speculations are being made. Probably sooner or later, RBI will allow, or will not allow, I would say, because crypto is already allowed. There was some sort of a some sort of stay which was put on onto which was put earlier, is rather RBI got it with the help of Supreme Court, and then later Supreme Court removed that stay, right? So there is now cryptocurrency is tradable, we know, but talk about from the point of view revenue and everything, there is no revenue attached to the government, and that is the concern. At the same time, one is the revenue factor, another is the level of transparency which a market should have. Though if you look at the whole thing, the way the cryptocurrency is being advertised, so the idea is it is more transparent. This is what the whole thing is about. But given there is no regulator as such regulating the cryptocurrency, so this is where some sort of comfort is not coming from the regulator. And it is not just about the Indian regulator which has got which is uncomfortable by making crypto as a one of the uh, main thing. So even across the globe, you will find regulators are not comfortable about having cryptocurrency. So if people are doing trading on cryptocurrency. Are you doing trading in cryptocurrency? Anyone doing?
I was thinking for investing in Doge because of this Elon Musk tweets, but I'm still
Okay.
speculating.
Yeah, so that is the whole thing. As in, even I have not started trading.
Because
Mine, yeah. So the lot of as in Bitcoin. Bitcoin is one of the cryptocurrency. Probably Bitcoin. When I talk about Bitcoin, probably people relate more instead of, because Bitcoin is one of the kinds of cryptocurrency. So there are a lot of cryptocurrencies. It is not just Bitcoin is one. Bitcoin is the one which is really gone up like anything. It is short like anything, and it is trading at a very high level. But there has been some decline also. Recently, in the recent week, there was some decline of some 16% or 17%, which was there in the news.
it's around 15%, sir, because Elon Musk tweeted
Yeah.
he's not accepting Bitcoin as a payment method for their cars.
Yeah. So given he's a celebrated figure, right, in the world, and he's very known face. So if someone like him comments anything of that kind, so there
But
is
don't you
a,
think, sir,
yeah.
giving such kind of power will be harmful harmful for the foreseeable future markets?
Yeah, so that is the concern at the moment. So because now it is at risk also, I would not say it is more riskier than if you even look at the with the OTC market. OTC market is also a riskier one, as we talked about. But we have not talked about the various stuff which is there in the OTC market. But just to give you an information, OTC is non-regulated, right? So your exchange market is a regulated one. However, the OTC market is not that much regulated. But still, you know what is being traded and who are the players in the OTC market. However, when you look at the cryptocurrency is something like it is decentralized, completely decentralized, right? So and what you buy and what you sell is being made in the form of blocks, and every block talk to each other, and that is how the communication mode is being created there in this with the help of blockchain cryptocurrency is goes hand in hand. So the technology which is used for cryptocurrency trading and everything is blockchain. So which is at one hand it is a good technology. I don't doubt about the technology itself is very nice. But the only problem is there are players who know how to actually run the whole system, and we don't know. What is said is there are this is decentralized. Anyone can look at this from their side and can, but it is not possible for a layman to understand that level of detail. And if you find if you maybe if you have heard this thing, if some currency is lost, if as in some kind of investigation is needed, so that is called crypto mining job, and that is highly paid job at the moment. Crypto mining is one of the highly paid job which requires some expert engineers, financial engineering people who can actually do and find out where this particular currency is lying. So that is how, because when you do buy or sell, rather I would say buy, when you adding number, so it is registered somewhere in the backend system, like this is the currency at the moment. And that is how the with every trade, with every buy which is happening, the rate is up and down, right? So technology overall is really solid. I don't have any doubt. The only problem is when you talk about currency, right? Currency is a this is a tender which is a government tender, right? So if some players start using this as a legal tender internationally acceptable, uh, and if it is not misused, if it is not manipulated, as long as this is not done, I don't think there is any problem. But if you don't know, like if someone manipulates it or not, if it is manipulated, even the regulator can't save you, because the regulator does not know who is operating it, how it is being operated. All these things, all these big questions are there under behind this cryptocurrency thing. So if in case it is run by, because what I understand, if crypto becomes really a successful thing, so there is a probability wherein the RBI can, or maybe some central agency in India starts like equity market, stock market today we have. Similarly, we can also have a cryptocurrency which is run by the government or some stakeholders. Then probably it may become some of the good tool. It can become really a good tool to use. So that is the future I can see. But as such in India, as long as political parties and the RBI as an institution is not comfortable, probably you can trade for sure. I as an individual, you as an individual, sure can trade. Especially people in India also doing trading in Bitcoin and many other cryptocurrency also. Even I know one of my friend who is doing some. He's using one cube, I think some Kuber, I think something, I don't know exactly. He told me.
Coinbase.
Yeah,
Coinbase.
yeah, right. So he was using one of that cryptocurrency. But again, the only concerns are, if it is not manipulated, if it continues the way it is being, then it is the best thing available in today's time. Even it is far better than your equities and all other market. But the only challenge is if it is manipulated, like you say, people start losing confidence, and that happens with every market. I would not say it is not, it is just the attribute of this market. every market has this thing of confidence. Confidence is the one aspect I'm saying that will remain there, that you cannot just remove it from the market. But the only one another factor is the manipulation. Manipulation means the people who say this is decentralized, right? So how this can remain decentralized, where one entity or one people or two people or maybe a handful of people don't misuse it. If this is not, if it is not misused, then probably there is no harm putting your money in crypto. So this is the only concern which most of the people have got, like how this, when you people say this is a decentralized thing, nobody can actually control it, like. So this is where the confidence should come. If people start having that level of confidence on decentralization process, probably this can become a really a game changer, you could say, in the financial market domain. So that's how. There are some players who really accept it. Some countries have started liking it, but how it is liked by all the stakeholder in the financial market is something is yet to be seen. Especially in India, people, uh, there are very few people who are actually trading in crypto, right? And at the same time, the regulators are not very comfortable about the whole idea. So that's the thing. That's my take.
So
Is your
that
friend, is any of your friend or anyone doing crypto?
I have a Kuber account.
Okay,
I was thinking about it, but still,
okay,
it's a highly volatile market. I can't really, and until or unless I know of the product, I can't invest even a penny on that. So
right.
about Bitcoin, it's about it. In 2029, it's a finite number. You can
Yeah.
mine a finite number of Bitcoin. But what's the problem having with Doge right now, which is having a huge volatility upward due to this Elon Musk tweet. It,
Mm.
Doge is like having unlimited. It doesn't have any caps. So
Okay.
think of this like it's like Venezuela on hyperinflation. So that's why I'm not thinking to invest in that, because at the end it's gonna
Yeah.
print unlimited times. It's a script.
Right.
It's gonna print unlimited times. It's not like Bitcoin, which is a finite number. So
Right.
that's the issue with it. That's why. And the crux
Uh,
of your what you have told is, I think it's uh, the Bitcoin won't be accepted in India, but the technology of blockchain might get accepted.
yeah,
That's what I'm
blockchain.
seeing
Yeah,
from the.
blockchain as a technology is definitely a game changer, and it is. I'm looking at not from the point of view of trading point of view. Even if you look at a lot of welfare scheme which are run, right? So like making a payment to farmers and all those things, right? If the blockchain as a technology is used, right, it can be a pretty big game changer, because what is happening today, how the money is being facilitated from one hand to another, is no one is able to track it properly. So blockchain technology can really play a very instrumental role in that thing, wherein all the welfare scheme which you talk about, be in the name of subsidy or be in other form also, even the NGOs which are doing the transactions, everything is done on blockchain. Probably this is going to bring more transparency, and more sort of controls would be there, like in terms of how the payments and all are managed. So that's my take. Maybe how it evolves over the year is something to yet to be seen, but this is the initial picture which is evolving, that this can certainly do a lot of things for the betterment of the society as a betterment society as well. So
And
let's
another
see.
question is regarding, sir, this week we have seen a quite a selling in market. So how
Yeah,
can we predict the selling through technical or fundamental analysis?
as in the equity in the stock market, you say?
No, sir, the equity, the stock market, yes.
Stock market, okay. So you see, what I see, my take is, your stock market will remain range bound. So the low, I would say, because what I see looking at the number and all, as in the coronavirus number, uh, though they are not substantially down, but they are coming bit down close to 3.2 and some 3.29, 3.3, 3.5. So wherein if it hovers around at the same number, or it goes down, so my take is, maybe for a month or two, right, the market will remain range bound under 14,200 to 15,000. So that's the extreme I'm telling you, extreme ranges I'm telling you. As on one side is your low end is 14,200, and on the higher side would be 15,000. So it will take some time, maybe a month or two. After 2 months, if the cases really go down, the vaccination drive goes up, right? So probably, though I would not say this situation is not impacting much to the market. It impacted in the initial few weeks only. So in April month there was some impact coming, wherein it actually touched 400 to 1400 to 200 or something, and from there on it actually it went up, right? So I am still of the same opinion. I'm not changing my opinion. I was having the same opinion earlier also, like this 1400 14,000 is the bottom, wherein it will only break when there is really no right measure is taken by the government to curb the COVID surge. So if COVID surge is not being reduced, which I don't see, because if you even look at the Niti Aayog news yesterday or maybe a day before yesterday, wherein they have said like we would be having close to 200 crore vaccines by the end of this year. So right, so there were quite a lot of news coming in the in the news channels, wherein they were saying if this is the production capacity of Serum Institute and Covaxin, as in the Bharat Biotech. So probably it would take about 3 years of time, no less than 3 years, to vaccine the entire population of India. So that is not going to be the case, because what I believe, government is really working aggressively, and a lot of solutions have already been made. So by uh, breaking this patent right and all, how this is really going to be implemented, it is still to be it still requires a lot of brainstorming on that front, and how many company are really capable of doing that, that's a different debate. So but I believe this vaccination drive is going to be effective, because now government have really learned the lessons. The only, if you look at the initial intent of the government, they were having very strong approach how to manage all this. But somewhere in the beginning of this year, they lost the whole idea of what they started with. So the idea was to have strong control, and the government also lost as in when they were having this election and all, they were in the campaign mode, and they didn't realize the COVID is still a problem. They thought like vaccination has come now and it is going to be a magic wand and all over, and the people would not be suffering. But that was not the case. So my take is the market will remain this way, and in the next few months or so, the market will definitely be heading upward only. This is the trend, because if you look at the previous crisis also, right, all the previous historical crises, you will find after the crisis, the market has always boomed for a year or two, and it will follow the same trend, because there is still a lot of room for growth and all, if you look at from the Indian context. So that is how the money will be flowing in Indian market, and for about 6 months or so, it is going to, maybe not for 6 months, I say for a year or so, it is going to be booming. Like maybe it can touch 17,000 also, 17,000 plus in next year, right? So that is going to be the trend, and thereafter it may cool down, it may remain not as in not an upward trajectory, but it will still be an upward only. So anyone doing trading into as in not trading, I'm saying, I know like most of you don't do trade. Nishant, do you do trading?
Yes, sir, I do.
Okay, okay, great. So anyone doing mutual fund,
Yes,
or
I also do that.
okay, apart from Nishant, anyone else?
Yes, sir. I am in trading and mutual fund.
Okay, Ajay also does both, right? So okay, fine. What about others? Anyone else doing trading or mutual fund for that matter? Okay.
So at the end, what's the context is that the investors had learned the previous lesson, like what happened in April, that we have seen a huge trajectory of downfall and a huge
Uh,
upset after that. So you are saying that it won't gonna happen this time, but yes,
no, no.
there will be
Yeah.
a upside after 1 or 2 months, I guess.
Yeah. As in for 2 months it is going to be range bound, and after 2 months it's going to be up, because what I see, there are positives only. Vaccination would be in full swing, right? Now stock would be available in quite a number. One is the homegrown companies, or rather I would say one is the Bharat Biotech would be producing with the help of maybe other players also in the market. And then COVID is in the Serum Institute is already doing a good job, so it will and then on top of that we would be having more of export coming from other countries. So I believe
Yeah, there
situation
are
would be better.
FIIs also. There are some FIIs also coming.
Yes, yes. So
Mhm.
the investment, and sooner this situation is under control, as in the coronavirus case are under control. If it goes below 1 lakh, the FIs inflow will come hugely. Because right now FIs are not, maybe they're very wary of the fact like how it is going to turn out in next month or so. So at the moment they have confidence, because right now they have pulled out some of their money from the stock market in the month of April on the uh, on this whole news, or on the whole this situation, right? But now in a month or 2 months time they will realize the numbers are going down, the government is proactive, and everything is falling in place. I am very sure the inflow will start setting in. So, and when FI's inflow come, the market picks up. So that is how this
So,
this
sir,
is going.
within in these 2 months, will it be a better strategy to invest in gold because commodity market is booming right now?
Yeah, gold, I think it is 46,000. How much is it? I'm not tracked it gold much, to be honest, but if you get it in the range of 45,000 or something, right? So then probably I say it's a good deal. 45,000 is a good deal. And if you can manage to get it below, which I don't think will be possible, because it is not going to go below that, because it's a fair price of the gold. It also touched about 65 something, like 65,000. So my take is, if you can get it in under the range of 45,000, 46, it is the best deal, or bad good deal, I would say. So and so as long as the equity market is not doing that good, or it goes down, the gold would, on the other hand, will do good. So it will, but now the equity market is quite stable, so gold is also not doing any great, so it is also quite at the same level. So at the moment it is fine, it's not a problem. But if it goes and up, I don't see as an in months to come, or in the year to come. So I don't think gold is going to give you much return, but from the diversification point of view, it is a good idea. From the diversification point of view, it's always a good idea to have gold in a portfolio, right?
That's that's all for
Yeah, yeah. Okay, so guys, any other thing, any other thought, any other point that you might have read in news, anything you talk about? It's more about, it's just not about me giving download to you wherein I share a presentation, we talk about those things. It's not like this, because we know this this financial market is a very big uh, big thing. Even what we do, it's just from the module point of view, but you need to have awareness about the industry and the market which you are into and for which you're trying, because the objective is to get into a banking or financial domain. So which is a which is a fundamental idea, but you need to also build on your knowledge about the financial market, and that you can definitely do with the help of the news which comes your way. Read that news, maybe deep dive that news in the form of searching more about those things, so that way you can really your build on more knowledge on what you already know. Right.
Sir, I was going through the
So
past
let
classes.
me open the PPT.
Hello, am I audible, sir?
Yeah, yeah. Anyone saying something?
Yes, sir. Actually, I was absent in the first class, so I was watching the videos.
Okay,
Means I have also passed the NISM exam of depository. So in the
okay.
participant of the market,
Hmm.
means apart from all the participant,
Okay.
I thought that we all read about something like RNT agent, register and transfer agent. Is it
Yeah,
the same role is going on right now, or is it means transferred to like a clearing agent and all? The role of
no, no,
registrar and transfer agent is there or not?
it is still there. Registrar and transfer agent are still there. In the case of your IPO, they play the role of entire admin work, which is done by them only. And also when you look at the mutual fund, pension fund, right? And
Yes.
so all these players have got a registrar and transfer agent to manage the redemption, subscription, right, and sending statement to the customer. So transfer registrar and transfer agent remains, it's an integral part of mutual fund, you can say. So in
Okay.
case of IPO and all, they play the role, we know, as we discussed in the class also, wherein Lincoln Time and Carby is also
RB.
there, right? And there
Yes.
are a couple of more names there. I do not remember all of them, but they play a significant role in terms of managing the entire admin work lies on their shoulder only. So that talking about application, right? And then managing the money in the escrow account, and then once the shares are allocated to the each individual, reconciling the money has come from those shareholders, right? So all this, and later putting that money to the issuer, sending it to the issuer once every kind of reconciliation has been made, and refunding the money back to the, refunding in a sense like the block which is put onto that money. uh,
Clearing the lane.
so yeah, removing that earmark. So that is something is managed by the registrar. So it is on their domain only, and it is in consultation with your investment bank also. But they say, and the command remains with registrar. So this entire work falls under the domain of registrar and transfer agent only.
Oh,
Right. Similarly, for mutual fund also, like they are there, they are integral to the mutual fund, because mutual fund require. If you look at hedge fund and mutual fund, so if you see these two players in the financial market, you realize hedge fund does not have that level of surveillance or monitoring, right? However,
yes.
mutual fund have got a lot of monitoring, so they are monitored by SEBI, and at the same time, they need to have segregation of duties. So segregation of duty is the main reason why different players are there. They need to have custodian, they need to have registrar and transfer agent, they need to have they need to have sponsor, they need to have AMC made a trustee, they need to sign, right? All these are more there on the mutual fund side or pension fund side, I would say. But they're definitely there. They're not removed as of now.
Okay.
Okay. Mm, okay. Okay, so today's topic is on money markets, right? So money market is one market which is part of OTC market, as we know. And money market, when you talk about, this is a short-term market. And on the other hand, you can compare it with capital market. That's the right comparison. So one hand you have money market, and on another hand you have capital market. And when you compare it, you will compare the instruments available in market and instrument available in capital market. So money market has got those instruments which have short-term maturity. So the maturity within a year, right? So those are traded in money market. Now, the fundamental question which arises is, why do we have money market, right? Why do we need a separate market in the name of money market? So the idea is, this is the market wherein the immediate requirement of funds or immediate crunch situation can be managed. So that's the main reason you have got separate money market. That's the whole idea. So this money market is helping banks, helping various financial institutions who have got their short term fund requirement, and that can directly be covered with the help of this various money market instruments. So we're going to deep dive and talk about those instruments which are there under money market segment, right? And so let's move on quickly. And so financial market has got, just give me 1 second. Okay, so moving on. So as we discussed for the financial market, so there are a lot of markets under the domain of financial market that we already know. We covered them in the first chapter about the financial market landscape, right? So, but if you look at this particular slide, what it talks about financial market, one is a capital market that is for raising long-term capital, right? This is the underlying significance of this market. And on the other hand, when you look at the money market, so the underlying significance of this market is transfer of liquidity. So you need enough liquidity to manage your business, to manage your affairs. That's the operation that you are having. So banks also require liquidity. So therefore, you need to have a money market, and where the other stakeholders or other banks can come together and accordingly do their transactions to manage their work. So that is the role of this money market. So if you just to give you more of information on the same similar lines, so the bank need to manage a certain cash reserve ratio that is called CRR in short form. So that is called cash reserve ratio, right? So that's a requirement. It's a regulatory requirement, one of the regulatory requirement, and they need to have that number met every day, right? So I guess at the moment this ratio is around 3%, but it is increased also, it is decreased depending upon situation to situation, and it is something which lies with regulator. It's RBI is the banking regulator, right? So RBI decides what should be the cash reserve ratio for banks. So they reduce it, they increase it depending upon how they want to keep liquidity in the market. So if they want to decrease the liquidity, so they increase the ratio, right? So and if they want to increase the liquidity in the market, then probably they will be decreasing the ratio. That is how they continue manage the this cash reserve ratio, which is applicable for all the banks under the regulation, right? So that's one. So so when one bank is having problem managing that ratio, what they do, they go into money market and they get money from the other bank. So that is how this transfer liquidity, if you can now relate it, how transfer liquidity is there. So you can reach out to other bank and you can ask like you need this much fund to manage the cash reserve ratio or whatever. You need not specify to the other bank why you are taking, but if you are taking money, so you are also paying in interest in return for the number of days you're going to use that money. And therefore by having that money with you, you are able to manage the cash reserve ratio and all those regulatory requirements which need to be met by every bank. So that's the reason this money market is going to give all these participants of the money market enough liquidity, right? That is how it is transfer of liquidity mentioned there, right? Any question, guys? Fine.
For this, sir, also the other bank charges some interest or
Yes.
any commission.
Yes, absolutely. So this is when you reach out to another bank, right? So the overnight interest rate is charged for every day, as in that rate is published by RBI only. Maybe you have heard this term. I don't know. There is a term. Let me just LIBOR. Like, did you heard LIBOR?
Yes, sir. London Interbank Offer Rate.
Yes, London Interbank Offer Rate. So this is a benchmark rate. So similarly, we have MIBOR in India, that is called
Mumbai
uh,
Interbank Offer Rate.
right, right. So this is your Mumbai interbank offer rate. So interbank is bank to bank, right? So when banks are dealing among themselves, so then they need to they would be lending basis this rate published by RBI, that is called MIBOR, and RBI is publishing with the help of the other stakeholder. It is not RBI is quoting any rate. No, it is not like this. So RBI takes an average of all the players in the financial market domain, and their bid and ask rate is taken, and then average out is done. And like LIBOR is also calculated on the similar lines. But the another thing is uh, LIBOR is going to be um, is no more going to be there. I guess already some of the maturities is already gone from LIBOR. When I say some of the maturity, that means LIBOR is published for different maturities, as in for overnight, for weekly, for monthly, for 6 monthly. So for this is how the LIBOR rate is published on a regular basis. They've got about six maturities. So six maturity means six different tenures, you can say. So similarly, MIBOR also gives this rate. Overnight is there, and then weekly is there. So that is how this rate is published. And this rate basically is published with the help of the other major banking players. So looking at the demand and supply, and their average is done for those rate, and that is how that rate is calculated, right? So that's a lending rate applicable when you take from the other bank. But there can be some favor given by the bank. If you are a good player, then even another bank can give you a better rate than what is the available rate for a given day. So that is with bank to bank. So it is a negotiable thing. It is not the once the rate is published, that is the only rate which you would be able to avail loan at. No, it is not like this. So when you negotiate deal with your bank, given this is a money market segment, and you have got a lot of banks in the money market, and you will reach out to multiple bank to get your loan or get your money at the least interest possible. So therefore, you would always like to negotiate a deal, not only with the rate published there in the for the overnight or weekly basis. You will try to strike a better deal so that you are in a win-win position, right? So that's the whole thing.
But that will also depend upon the mutual relationship between the banks, so that they can borrow
Yes.
at a lesser rate.
Right, absolutely. It depends upon the mutual relationship, because if you know, if I need money tomorrow, you would also need money, right? So it goes this way only. Today, I have got a big client who requires money. I give that money to him. Because of that, I'm falling short on my cash reserve ratio. Similar thing may happen with the other player also. Tomorrow, you get a client, you are giving that money to that client, and you are also falling short on your cash reserve ratio. And if that's the case, then you would also reaching out to the other banks in the financial market to cover your cash reserve ratio requirement. And so that's a mutual relation which banks share with each other. So they're not going to charge they're not going to charge above the published rate largely, but they can have a spread also added depending upon the risk associated with the lending. So spread means LIBOR, MIBOR, all these rates which we talk is a benchmark. Benchmark means this is how the rate should be. So if I'm adding an extra spread, maybe it is called basis point. So in when I say 1%, 1% is 100 basis point, right? So 100 basis point means each point in 100, or you can say so 100 basis point means 1 point is 1/100th percentage, 1/100th. So I may add 15 basis point additional to what the rate is there for a week, right? That is basically it is possible depending upon which counterparty I'm dealing with. If I'm dealing with a riskier counterparty, if they reach out to me and ask for the loan, probably I may also add a spread, because I see there is a risk attached to the deal. However, if I don't see any risk, so I would just be giving on on the better rate to my counterparty. So largely, money market is considered to be a better managed in terms of risk, given the players in the money market are are those players who are very reliable in the financial market, especially banks and all big corporates and all. So therefore, this is how it is. They do not charge a greater spread, or maybe it is at times given at a very reasonable rate to the other party, because this is a mutual relation you need to build. It is one day you need money, another day your counterparty need money. So you cannot just charge any random as a random, or greater spread on the money which you are lending out to your counterpart. So that's how it is. So this is if you look at this
So,
particular
sir,
slide. Yeah, go ahead. Yeah, go ahead.
yeah, do these instruments have, what they say, collateral? Are these safe enough?
Okay, so so some are not as in many which are not secured, and there are few which are secured. Especially this interbank lending is not secured. It is more on trust only. interbank lending which is happening, this where when you reach out to another bank or another bank reaches out to another bank. So this is not secured way of lending. But there is another concept which is repo. Repo, wherein if you are buying security or if you need money, then you are placing a security in exchange. So that is a secure transaction. Repo transaction is secured. So repo transaction is again used for availing money only. So I'll talk about will talk about one by one. So just to give you a flavor of repo, repo is a transaction what you're doing in case of repo. So you're selling security to a player with a promise that you will buy the same security at a later date, right? So when you're selling a security, so you're when you sell, that means why you selling, you need money, right? So the security goes in the name of your another bank, and you receive money, you use that money, and once you're done with the requirement, you return the money.
Pardon me, sir. There is a constant vibration coming out from your mic. I guess that is very disturbing.
uh,
Please rectify it. There is a vibration like some sort of windy sound is coming out from your speaker.
from mine.
Yes, sir.
Okay, 1 second, let me just check, give me a second, 1 second, give me a second, let me just check. Yeah, how's this now? Is it better?
Yes, sir. Better.
Okay, okay, fair enough. So let's okay. So we're talking about money is equivalent to liquidity, right? So this is how this money market is termed as. It is called a liquidity market. Okay, so we were talking about repurchase agreement, right? Repurchase agreement will be talking in subsequent slide also, just to give you a flavor. So this is one instrument which is issued to another bank, or rather sold to another bank, not issued, I would say. It's sold to another bank on the back of money. And that money can be used by, if you anyone has seen this movie, I would say web series, the recent one on who was the guy, Harshat Mehta. So that gives some of the information how this money market was being used back then. So back then, just to give you an idea, it was there was brokers also used to play a role, which is not the case nowadays. Now it is a transaction happening directly between a bank to bank only. right? But earlier it was not like this. Earlier the brokers used to facilitate money market. So if I need money as a bank, right? So what I could do, I could put money, I could reach out to a broker. I could reach out to a broker. A broker was responsible for bringing a best deal for me or good deal for me. So Harshad Mehta was also one of the institutional player back then. He was very big name, you already know. So he used to do all these deals uh, for banks, right? And uh, that way he was able to use the money also for certain number of days. So this was a loophole back then in 2019, 90 or 2019-92 around, wherein the money market was being used by the brokers also for their stock trading and also. How? Though that was not allowed, it was illegal, but there was process of going to broker finding a deal for you, and until the deal is found, so it used to take about few days. So until that deal is found, so the money will remain with the broker, and people and in the money market domain, they realize this is really an attractive thing, because they were able to make money with the help of stock market. Like if there is a Harshad Mehta like person who commits or promises certain return to the person at SBI, or for that matter any other bank, like you give me this money, I'll give you a security, I'll give you a better security for you to you, and at the same time I will I will also give you money from some other sources. That is, when I say other sources, mean stock market. So that is how this money market was being used back then in 1990 or 1992. Now the broker involvement is not there. Broker, as in the stock market, brokers are not there. But I would not say the market is completely off broker, but there are some dealers which are there, and the dealers are now running the market. So dealers are still there who do manage the who manage your bond dealing and all, right? So that is still there, but the stock brokers and all are not there who can manipulate the stock market with the help of the money market money. So that was being done in the past. If you maybe if you have time, probably you can see this movie. This is available, not a movie, I would say it's a web series which has got about 10 episodes, right? So it is on Sony Live, I guess. I'm not sure about other uh, apps. Okay. So introduction of money market. So money market is a part of global financial market that deals with the short-term lending and borrowing, right? So this we know. Unlike a stock exchange, the money market is not a particular place. It is a system. Mode of transaction. Transaction may take place with different persons, telephone, fax, without personal meeting. Funds are available in this market for periods ranging from a single day up to a year. So who all players are there? Government bodies are there, corporation, individuals, all players are there. Features is a short term, it can be for day, it can be up to a year. So it's not a location, there is no physical location that we have for this market. It is a OTC market. So when I say no physical place, that means it is a over the counter market. Type of trade, over the counter or wholesale, you can say, right? So these are the players, major players in money market: government, bank, financial institution, corporate, central bank, dealers, right? Mutual fund, foreign institution, investors, banks. So these dealers are the ones who are managing the liquidity, who are doing daily daily trades in the money market, and that is how the liquidity is there. Okay, so if you look at the structure of money market, so you have organized money market, then you have unorganized money market. So there are Reserve Bank of India, scheduled commercial banks, lenders, development banks, investment institution, regional rural banks, foreign banks, state finance corporations, DHFI, right? So these are the part of your organized money market, right? And these are the player who are the unorganized money market, indigenous bankers, domestic money, nidhi chits, traders, friends, brokers, dealer. These are on the unorganized side of the money market, right? So anything not clear on this slide? If you need more information, it is just for the point of view understanding only. So not uh, as in what all falls under the money market, organized money market, and then on the other hand what falls under the unorganized money market. So you know about Reserve Bank of India, you know commercial, scheduled commercial bank. Commercial banks are all the banks that which are there. It can be classified as PSU bank, private bank, foreign banks, right? So these are all commercial banks which have got license from the from RBI to do commercial business. Lenders, it can be your NBFC and all. So those are the lenders, non-finance and be non-banking financial institutions, right? So development bank, so development bank like FICCI, IDBI, all are under the category of development bank. They were formed with the purpose of development in mind, and development in the sense they were supposed to supposed to look after or supposed to look after, not they are still doing it. They are supposed to look after the interest of institutional players and cooperative players, right? And also public sector. Nowadays the earlier idea was, it was largely to manage the requirement of small and medium enterprises and all those things. But now they also support public sector banks, so with the help of the loans and all, right? What is the anyone?
Discount and Finance House of India Limited.
Yeah. So what are their roles? Any idea what they do? DFHI.
They are financing housing plans.
Yeah,
And they actually do means discount and purchase treasury bill and rediscount it. Like
yeah,
bills away discount they do such kind of.
right, correct. So as the name is discount and finance housing, uh, right? So if you look at the discount name, as in the word discount written there, right? So they buy securities on discount from big players like Government of India and all, and then they do kind of, they manage the liquidity in the market. So they are the player who do the regular trading in securities, which, because when the auction of security is done by the government, it is not done on daily basis, right? The security has got has you talk about the bills, T-bills. T-bills have a different maturity, right? 91 days, then 182 days, then 364 days, right? So they are issued in a certain um, maturities. So once those are issued, so the trading and everything is managed by these kind of player who ensure there is enough volume in the market, so that if someone does not want to continue with the position, so that person can offload the position, and another player who wants to take on that position can take it from the money market. So they are the ones who are actually sort of giving liquidity in the market. So they buy in bulk, they buy in a large quantity from in the auction market from Government of India or from the other corporates, other banks and all, their bond and all, especially the short term I'm talking here, and then they sell it to the other player in the market, or buy it from the other player also. So that is how the DFHI is there. Okay, so unorganized market, indigenous banker. What is indigenous banker? Any idea?
Like the lane, the Sudkhor, something like that.
Right. So yeah, indigenous banker are like this only. So there were used to be, if you recall the previous time there used to be as an big Jamidar and all. So they used to run banking business from their home. They were also taking loan. They were also giving loan, and they were also taking deposits. Also, they were giving interest to one segment of people, and they were giving loans to another segment of people.
So that was managed by a few, big name in a particular region or in particular area. uh, so that was in a previous and old time. Nowadays it is quite limited, I would say. It's not that huge. Maybe in the rural India it is still there, but not be maybe not that large, mm, at a large scale. That could be the case. Domestic money. What is domestic money? Any idea? Domestic money is more of a, it's a term that is used for as an you might have seen, there are a lot of centers which are made in the rural area, wherein the idea is to transfer money from one person to other person depending on the requirement of the customers. So that those small shops which are made are called a domestic money. You can say shop kind of thing where domestic money is being circulated and used. That is how domestic money is there. It is more of managing a requirement of the customers at the domestic level. Nidhis and chit funds, you probably know already, right? What is nidhis and chit funds? Any idea? Any example of nidhi and chit funds?
Funds like Sharda chit fund, something like that.
Yeah, right, right. The name you said, Sarda Chit Fund, right? So these kind of schemes which are rolled out by some of the, as in the players, and this was run by who ran this scheme? I guess Subroto Rai, right? This
This Subrata, it was for Sahara, I guess. Sahara Subra something.
yeah, right, right. He ran some Sahara one that was also, that turned out to be a fraud only later. He
Sharda Chit Fund was someone from the Mamata Banerjee's party.
Right.
Actually, he was his brother or something. Some relation was there with Mamata Banerjee.
Okay, right. So yeah, right. I remember now. TMC.
Sir,
Yeah.
I think the Sarda chit fund is like chit fund, but it is CHEAT fund. But this chit fund is like different. Like means I may be wrong, but it mostly done in the wholesale market. So in one wholesale market there is 10 or 12 shops. So they
Uh-huh.
do one thing. They means one person is appointed, and
Uh,
they take on committee, and they means bring money, like fixed amount of money, like 1,000 rupees from every person, and
uh-huh.
they give that money, the whole money collected from 10%, give to one person only,
Right,
and
right,
in the next term they give to another person, so that it is helpful them to buy their things, and it
mm,
is a like no cost to them.
right,
So it
right.
is like means lottery system is like that. And so they means
Uh-huh.
cheat means take the cheat and bring out the
Uh,
name of some person. If
mm,
person of name B come out from it, then whole money is given to them. And the next time the B is excluded, and all the other people are cheat is there. The name
right,
which is came out, they give to that person.
correct, correct. So the one that we were discussing about the Sahara ones, so Sahara was doing the similar thing only, wherein he was receiving money. It was maybe in the it was very small amount. It's not a big amount coming from the individuals, and then he rolled out that money to players, wherein he was not able to recover that money back, or maybe he channelized the money in his own fund, in his own business maybe, because he really collected a huge money. That this case is still being still there in
Of course, yeah.
right. So this is still there, and for this he was there in jail for about few months, I guess, if I'm not wrong. Subrata Roy. Yeah. So yeah, so this is, as in, this is how the money market is divided, right? So now let's talk about these sub markets, or as I would say, which are again part of money market only. What is call money, bill market, 364-day bill market, CDs, and all this thing. Okay, let's start with the commercial bills and treasury bills. What is commercial bill? Any idea? Let's talk about one of, we have got subsequent slide based on these instruments only. So let us first start with your all these things will be talking. So okay, let's first talk about, okay, let's first cover the interbank lending. This is the call money market, right? It is part of the call money only, the interbank lending. Okay, so the lot of terms that you can see written there. call money, notice money, weekend money, term money, and intraday money, right? So what is call money? Right. So if you look at the term money definition is very clearly written there, right? So this is the money which can be lended to another bank, and there is no such term mentioned there, but it is sort of renewed on day-to-day basis. And if the lender need funds, lender can give a call to the counterparty whom he has lent the money, and then the money would be available the next day, or rather I would say same day. So that is how this word call money is written there. So you make a call to the counterparty and your money is back. So if you're making the call in the evening, probably the money would be back in the morning only around 11 a.m. So, but however, if you're making the call in the morning itself, the money should be back within the same day. So that is how the name call money is given to this kind of a lending, which is done between bank to bank only. Okay. And next is your notice money. Notice money is for a period of 2 to 14 days, right? And usually 2 to 14 day is the notice money period, but it can be customized, it can be changed also, and it can be made for week also, it can be made for 3 days also, right, depending upon the contract which is signing with the counterparty. That is why the notice, you already given a notice to the counterparty, and within that notice the money would be returned to the other party, right? Then next is weekend money. This
So,
is, yeah, go ahead.
call money is between two banks,
Yes,
right? Lending between two bank, and
right.
notice money in between
It is,
bank only, or individual, or what?
no. It is all with bank only. It's an interbank lending. All these terms that we are talking here, it is between bank only. Interbank lending. We
Okay.
talking all the terms, be it your call money, be it your notice money, be it the weekend money, your term money, all these terms which are written there is for bank only. Okay, but the different names given for different kind of uses of that money, you can say. So if you need money for a number of specified days, so maybe within 14 days, within those 14 days, so then you will call that kind of uses would be termed as notice money, right? However, if you are taking money on Friday, right, and you're going to make this payment on Monday, then this kind of money is called weekend money. If you borrow on Friday, the last working day of the week, right, and make this payment on Monday, so you are able to use the money for weekend, right? So this is called weekend money. Term money is kind of a term where this is specified, as in if it is for uh, for a month or so, that term will be given there. Refers to money loaned or termed for a fixed period, such as a week or a month. So if so, that term would be mentioned in the agreement for how long you are going to use the money. So that is how this the word term is given there. Okay. Then the last is intraday money. Intraday means on the same day. It refers to money loaned and repaid on same day. Borrowing takes place in the morning of the business day, and repayment is scheduled for the same afternoon. So if you talk about this kind of lending, right? There was a question, I guess, is it secured? Is this a secure transaction? So I would say this is an unsecured transaction only. It is being done on a trust only, right? So big banks are transacting among themselves. So banks are under the purview of banking regulation, right? So it is very strong, robust mechanism or a system, and there is a very it's I would not say it's not possible that banks can default. Banks can definitely default, but still the probability of banks defaulting is not that they can default like anything. And given that these are these short-term instruments, so it is less likely the bank will default on their commitments. Right? Any questions here? Okay, let's move on then. Okay, so this is a market where institution banks manage their day-to-day deficits, surpluses of money. Banks, institutions require funds to manage their daily expenses and withdrawals. More importantly, they need to maintain the liquidity balances per regulator. CRR is the one that we talked about in the previous slides. CRR stands for cash reserve ratio, right? So this is what bank needs to. So just to give an example of CRR, like if you have got a deposit of 100 rupees, right? And if the CRR ratio is your 3%, which is in the current circumstances, so for every 100 rupees, you need to keep three aside, and that is just to manage the risk sitting on 100 rupees. So one is your CRR, that is cash. You need to have certain money in the form of cash, and rest of the money you can keep in the form of other assets that can be commodity, gold, and all other assets can be categorized under the form of SLR. SLR stands for, any idea?
Statutory liquidity ratio, it is
Right.
18%.
Right. In the current environment, it is 18%. Again, these two ratios are subject to change by the banking regulator RBI. So they review the environment, and if the environment is somewhere is environment needs money, then they will reduce these ratios so the liquidity can be enhanced. And if they think they need to curb the liquidity in the market, so they can im increase the ratios. That is how it is done by the banking regulator. So statutory regulatory ratio is another one. So this ratio is again to manage the liquidity. So bank need to have enough money in other forms of assets like gold and commodities and all other things. So they need to have, you can say, 18% of 100 in other form, and 3% of 100 in cash when they are lending money to their customers or clients and all this thing. Hope it is clear. CRR, SLR is clear. What with this ratio, what these ratios are all about. Okay.
Yes, sir, it is clear.
Okay, great.
Just for a clarification, in short,
Yeah,
we need to maintain 21% within the bank, and 90, rest of the amount we can lend to the customer. That
right.
means 3% in cash, 18% in gold, and the other deposit.
Yeah, you can say that way. So for every 100, you need to have at least 20%, 18% in your this form, right? And 3% in the form of cash. You need to manage. You need to have before you can lend that 100 rupee to anyone, right? So uh, that is how these ratios are there. Let's move on. Okay, so maturities of 1 week or less, overnight rate if loan is less than 1 day. So as we were discussing, so the rate is applicable, right? So that is the interbank lending rate, and that is calculated, usually the benchmark used is MIBOR, right? And that where the overnight rate would be published if it is being, and usually this is applicable for every day. Overnight rate is charged for every day, rate is levied. Or if it is already decided it's a weekly transaction, then the weekly rate can also be applicable. So the rates would be available for different maturities, you will say, but it is 1 week or less. Maturities of 1 week or less is given in this rate calculation. Okay. So how the rate is calculated for interbank lending, a money market instrument, interest is payable on the principal value of the instrument. Interest is paid at the end of the loan period along with the repayment of principal to the investor. So principal plus interest will be paid back to uh, the investor or to the entity who has made that payment in the first place. Right. So that is how this money market is there. This is just a simple calculation is given there. It's a simple interest formula, right? Principal, interest rate, number of days for which it is. But here you need to uh, this yeah, this is simple rate, a simple interest rate formula is used. But if you look at here, there are different way of calculating day count convention. Day count convention is basically taken to calculate the daily interest, right? In which form you need to. So there are four different day count convention. Day count is actual by 360, actual by actual, and then 30 by 360, right? So just let me just put it here. Give me a sec. Let me show you my Excel, and we can. DCC, right? DCC stands for day count convention. Day count convention is applicable even for fixed income instrument and also for money market. Why? Because there are four methods of calculating interest for each day. That is called A by 360. A is called actual. Actual means actual number of days. When I say actual, actual means actual number of days you use that money. Another is your 30 by 365, right? And another is actual by actual, right? And there is another, this is one, then there is actual by 360. So these are four methods of calculating interest, daily interest. So one is the monthly basis, others rest all are daily basis, you can say. So these are the method of calculating the interest on a given security. This is also used for fixed income instruments. This is also used in money market. Right? Any doubt here? So why we are using it and all this? This is to just to calculate the actual days. So here, if you see this screen here, this is given T upon 360. So the day count convention is actual 360. This is the day count convention which is being taken. So when I say there are four different day count convention, basically means across the globe, different one can be seen used. So UK might be using a bit different, US might be using a different, India can use a different day count convention as per their their country, or you can say as per their country uses, or so one which has been started by them, maybe they're just sticking to one, that one only. So that is how it is. So here if you look at this one is actual by 360. Actual means number of actual day, and then this simple interest rate formula is given there. So if it is 92 days, so this is the principal amount multiplied by the rate is how much is the rate? 5.75, right? This is given here, and the number of days 92 by 360. So that's the amount. It is again given the same thing that we looked at here, just given with the form of as in the normal Like see here, for certain currencies such as sterling, however, the interest is calculated on the assumption of 360 days a year, which is based on actual by 360. This was actual by 360. This is actual by 365. It's a different day count convention. So there are four different conventions which I just mentioned in the Excel file. So those are used for calculating the interest only. And these depends upon currency to currency, or you can say different country to country. That way also you can say. Advantages: high liquidity, high profitability, maintenance of SLR, safe, cheap, assistance to central bank operation, uneven development, lack of integration, volatility in call money market rates. So this is to give you the high level advantage, disadvantage. Anything you need explanation, you want me to explain any of the terms maybe that you want to understand, or you just want to for your or it is fine.
Sir, if any one bank is taking means call money from another bank, so they
Yeah.
need to means keep the record, means they have to maintain a record that we bring that sort of money from the bank B. That they have to maintain record, or it is like only call money.
No, they need to record, as in the accounting record has to be maintained, because without accounting record you cannot even move a one single penny, right? So
And
so
they
that
also get the receipt, means the lender bank also get the receipt.
right, absolutely. So that needs to be maintained. That as in is the absolute need. But there would not be any back, as in the collateral backing would not be there.
Okay, is it the same like bank receipt in the means that movie Scam
Yes.
1992? Bank receipt is the same.
Yes, it was kind of a bank receipt, like you saw that movie. So, but if you look at that particular, if you look at that movie, so yeah, so you can say that way only. It was like kind of a bank receipt only. So that was more of an interbank lending. But they were not buying. They were. It was not bank to bank. They were even buying security from any other player also. Wherever they could get that security cheaper, they can
Yes.
buy it. And on top of that, they were giving that money to the broker. If you have seen that movie, the money was going in the broker's account, in the current account, then broker was
Yes.
using that money in the stock market. That's one. And at the same time, they were just getting the BR. So that was an acceptable way of doing the transaction back then. But BR is always risky, because BR basically means you're just hoping the security will come, but actual having actual security actually, or having BR is just a different matter, right?
Yes.
Yeah. So you can say that was kind of an unsecured deal only. That back the information shown there, it was an unsecured deal only. But the BR is basically who is giving BR? The one who has made the payment, right? So BR you are giving, you are basically saying you have received the securities. Right? This is what you're saying. You receive the security. That's the reason you are acknowledging, like, I'm making a payment and you receive the security. But actually, you have not received the security. So it's your risk. You should not be giving BR as long as you don't have securities. Right? So that is how it should be. BR is bank receipt, right? So bank receipt means you have received what you were supposed to receive. So that is how it was. Okay. Anything else you want to check on this particular slide, or shall we move on? Advantages, disadvantages. I hope this is clear, right? Shall Okay. So this is to give you a trade economics, how a trade of money market would look like. Trade date, settlement date, price, notional amount. What is notional amount? Trade counterparty, trade direction, day count convention, DCC, calculation of interest amount in the deal, brokerage, settlement amount, and standard settlement instruction. So I guess most of the terms would be known to you. You would be familiar to these terms. Maybe let me just touch upon couple of them, which is maybe some of you are not aware. Notional amount. Anyone aware?
And notional amount means the amount I have invested. Let's say I have purchased a share of 1000 rupees, and that means I am the amount I invested. And if I make 10 rupees of profit, then 10
Yeah.
rupees will be notional profit, not actual profit. Once
Yeah.
it is means bring back to my bank account, that will be
Mm.
my actual. Still,
Right.
it is invested. It is called notional amount.
Right. Correct. So notional amount is a contract that you have signed with another counterparty, which amount is not settled, but you have agreed for that amount. As in the investment or the agreement for the amount is for that particular amount. As long as that is not settled, so it will be termed as notional only. So you have agreed, but it's not settled. So that's the reason we are calling it a notional amount in the first place. But once it's settled, it becomes the settled amount. So like it is written here, right? So you can see settled amount is given there and notional amount. Two words are written there. So once the amount is settled, the same amount would be called the settled amount. Before that, it would be called a notional amount because it's not. It is a contract only. It's an agreement. But if it is settled, then the same will be called the settled amount. DCC we have already known. DCC is called Day Count Convention in its full form, and it is used to calculate the interest on the deal that you're doing with the counterparty. Right? So different day count convention basis the currency and the country acceptance of those conventions. So that is how this DCC is there. Then the settlement amount. Okay, what is standard settlement instruction? Anyone? Okay, so standard settlement instruction as a word is used for the account detail. So when I say account detail, basically where I'm going to receive the cash, where I'm going to receive the securities is needs to be specified with the help of SSI instruction. SSI is a short form, and the full form is standard settlement instruction. So this instruction basically gives information to counterparty where the cash need to be instructed and where the securities need to be received, and vice versa. So that is the reason you need to have a certain standard settlement instruction from the party in order to settle the transaction. Okay, so these are the terms of a trade. So just to as in give the information. Anything not clear? I hope it is straightforward, right? There is no such explanation is needed. This is just an overnight deal example given there. So there's a trader from JP Morgan need to borrow 1 million overnight. ON stand for overnight. Available, city trader says available at this rate 2.20, not agreed. So JPM trader says no, I'm not okay, comfortable with this rate, and I need 1.95. City trader last quote 2%. So he changed the quote and he made it 2% for JP Morgan, and they both agreed, and that is how this is booked in the system. It's an overnight deal, so same date is there as in the next maturity date is the next day only. Notional amount is given there, currency is given there, interest rate is given there, commission is given there. Day count convention method is also there. RMS linkage ID. RMS is a risk management system, you can say. So that ID is given. So that is how. The first screenshot is for the Reuters conversion, and second is example of inputs or the sales assist team on the risk management system. Right. So this is how the trade is done. Okay. Now coming to T-bill. Any idea what T-bills are? Anyone has heard this term before?
Government issue treasury bill for short-term requirements.
Yes, right. So these T-bills are again debt securities which are used by government to raise capital for short-term requirement. Right. So if you look at this definition given here, T-bills are short-term debt obligation backed by the government. Right. So it can be for 1 month, it can be for 3 months, it can be for 6 months also. And T-bills are generally sold in a denomination of $1,000 in US, Now this number has been raised. It is, I guess, $10,000. Uh, but earlier it was $1,000. Okay, so T-bills are can be issued by local government, can also be issued by municipalities, right? So that is how the T-bills are there.
On what basis T-bills are issued?
So these are issued uh, by the government to manage the infrastructure or to manage the welfare schemes of a particular state and all. So the government can, if the government also need money, right? Like we need money or the companies need money. Similarly, the governments also require money to fund a project or to finance a project. So it is a kind of a finance which is coming directly from the people of the country. So if the people of the country are interested to pool in money in the form of the debt instrument which is being rolled out by the government, and the government is there, so you know your money is secure, your money is not going anywhere. And at the same time, the financing which government need, they can they can need their financing from the banks also, but maybe the rate charged would be different. So the T-bill is basically a debt instrument where the government specifying the rate of interest. They're going to give you 5%. They're going to give you 5.5% as a rate of interest, or a return, you can so say, uh, against the money which you are loaning out to the government in the form of T-bills. So these are the debt instrument which you receive from government, and against the debt instrument there is a backing from the government which is in the form of the collateral. So that's the promise coming from the government, and it is for the financing. Financing can be for the projects, it can be the project that the government is running. It can also be for the money requirement which government has got. Maybe look at this particular scenario, the COVID scenario, and assume a case where the Delhi government is not able to manage the salaries of the employees because of the whole situation. So they can also go and raise securities, right? Government securities, which is and those securities can be bought by the Delhi Heights, and it is backed by the government, so it is more secured. You know, the government can't fail, and with that money they can manage the expenses and all those things for the period of time, right?
Means government lending something, na, means government lend infrastructure value or something to issue T-bills.
Yes, you can say that way. Yeah, government is financing, so as in money is needed to finance those projects. So you can say money is being channelized from the retail, not retail, I would say. Retail people also are participants, but it is majorly done by the institutional players. So they all buy those securities, they fund government, and government again fund it to the project where they need that money, right? That is the one example, and they can also use that money for some other purpose, like the example wherein they don't have even money to run the uh, whole state for a month or two, in terms of managing the wages and salaries of the employees of the various sectors, various pu- public sector companies. So they can also take money in that form, and that can be used for a short time, right? So that as in various other expenses, just to name a few, one is the financing of project which government has in their mind. Another is for managing the expenses which they have got, or to reduce the debt also. At times, to reduce the debt, they go for another debt. Okay. Is it clear, or not clear?
Where we got these T-bills, like in stock market or in banks, or how can we know T-bill issued by government?
Okay, so it is something which is published by the Reserve Bank of India only. So if you talk about from the Indian government point of view, whenever government wants to roll out any of the securities, it goes through the route of RBI. So RBI is RBI advertises about T-bills, right? And then these are auctioned
Like bonds.
like bonds. Yeah, T-bills are bonds only. The only thing is T-bills are for short term, for a year only. So that's the
Okay.
reason these are bills called bills, but it is a kind of a bond only. In another way of bond, you can say bond are the long term
Mm,
securities.
okay.
So So you can say this is a bond in a one form, which is routed with the help of bonds are issued with the help of RBI whenever government wants to issue those bonds, and it can be directly bought from the RBI kitty only. They have got one I guess portal is there. RBI manages that portal. That portal is called. It is online. I'm not remembering the name of that portal, but there is a portal name. I guess it is. Anyone remember the portal name? What is the portal which does this all online auction and transactions of securities? Anyone remember? There is a portal which RBI runs for all these bond securities. No idea. And it can be managed your, let me just check if there is some information available online. We'll look at it. We'll look at separately. No worries. So I'm not able to find it right now. Anything. Okay, so this is how this is done, and bond are largely bought by the institutional players, but it can also be uh, offered to public at large. So it is not, it is just the institutional player are allowed to participate in bond buying, and it can be bought by provided government is comfortable issuing it to the retail investors also. And then this is the maturity given 1 month. It can be issued for a month also. It can be issued for the 3 months. It can be issued for 6 months. And the best part about this kind of instrument is this, wherein these instruments are issued at discount and redeemed at par. So when I say issued at discount, so what does it mean? It means, let me just show my Excel file. So issued at discount. Okay. So if the face value or the nominal value or face value of the bond is dollar 10,000. Okay. So maybe the issued price is okay. So this is the issued price. So the actual value is face value is this given there, right? And so when I say issued at discount means how much investor is going to pay. Investor is not going to pay this value. Investor is just going to pay your 9,800, which means issued a discount. So the original face value says the bond is worth $10,000, but how much you are paying from your pocket? You're just paying 9,800 rupees, right? So when the maturity happens, so let's take it's a 3-month bond bond bill rather. Okay, so you're going to receive how much? You're going to receive 10,000. Okay, so that's how these T-bills are there. So these are issued at discount and redeemed at par. So hope this is clear. So there would be a face value mentioned in the T-bill, and you would be receiving the same value at the end of maturity. So if you look at this, so this difference is the profit for the investor. Okay.
Our amount more than 10,000 or 10,000 according, मतलब equal to face value.
Yes, right. So your amount means as in the money which you're going to receive would be higher than what you paid. You paid only 9,800, right?
But par value is always more than the face value.
Par value is
If
always
face value is 10,000, then par value should be more than the face value, I guess.
par value should be more than the face value. Par value and the face value both are same, as in used for the same term only.
Yeah, yeah, these are the same terms. Yes.
Right. So this is in case of T bill. This
ओके
is
ओके, वो आई थिंक तो प्रीमियम वैल्यू होता है.
okay. Okay. So fine, no worries. So this is how in case of T bill, right? So T bill is issued a discount. When I say issued means you are paying less money than the actual value of the instrument. So actual value of the instrument is $10,000. You are paying $9,800 only. And when this matures, as in when it is 3 month bill, right? 3 month contract agreement with the government. So you're going to receive $10,000. There is no interest. This is the only amount that you're going to receive. There is no interest. There is no DCC method would be used for calculation of interest here for this particular instrument. Why? Because this is the only amount that you're going to receive. There is no plus. There is no minus. So this $200 difference, which you're getting in excess, is basically the interest, you can say. This is the profit, you can say. This is the interest, you can say. Whatever you want to call it, you can call. So that's the benefit for the investor. Right? Hope here. Okay. Let me. Okay. So let's move on to. So T-bills are issued through a competitive bidding process at discount from par. This means that rather than paying the fixed interest payments like conventional bonds, the appreciation of bond provides the return to the holder. So as we already discussed, so instead of paying the fixed interest rate, so what is the return to the investor? Investor return is the payment that is coming, the entire payment which is being made at one go. So that is the only return which the investor is going. There is no interest that would be coming in when you as an investor put your money in T-bills, right? So let's say, okay, let we talk about this process also. This return T-bills are issued through a competitive bidding process. This bidding process is the one that we also did in IPO, that is called Dutch auction process and book building process. So Dutch auction method is a method of competitive bidding. Same method is also used for for uh, for finding the price of such bills or such bonds. You can such bills, I would say, because this is about the bill that we talking right now, but also used for the bond pricing also. That's the same method is also used for bond pricing. Here it is being used for bills, and for bond also we can use the same method. So let's look at this particular competitive bidding method. So let's say you want to buy a T-bill from the US government and the price of T-bill is 9,800. Duration is 13 weeks and on maturity 10,000 is $10,000 is what you're going to receive. Securities are priced via regular scheduled auction process. There is an auction process which happens upon treasury announcement of size of the upcoming auction. Tenders or sealed bids are being solicited. Bidders submitted two types of bids. One is called competitive, another is called non-competitive. So we'll more concern about competitive at the moment. Non-competitive is meant for retail investors, not for your your institutional investors. So competitive bidding is meant for the institutional investors. Non-competitive is for your retail investors. So let's first focus on the competitive. There is a entire method is given there. Competitive bidder, the amount of securities the bidder wants to buy and the price that the bidder wants to pay. You remember the same kind of method we also talked about there in IPO process, the book building process, wherein your underwriter goes out to the institutional investors and he takes a quote. He takes a quote of from those institutional investors, mutual fund, pension fund, insurance company, as in what number of quantity they would be they would be comfortable to buy and at what price they would like to buy, right? So that is what is called competitive bidding. Same is the case here also. The amount of securities the bidder wants to buy and the price the bidder wants to pay, this is defined the term of yields. So, right, so you can say the price, when I say the price that the bidder wants to pay, this is defined in the terms of yield. So, so okay, okay, so now the price of securities in the auction is set based on the prices offered in competitive bids, taking the average of all accepted competitive prices. So then again, the kind of an average method is used to calculate the either it can be the one price for all, that is called the uniform pricing. That's and it can be different price to different stakeholders. So that is called discriminatory price. So that two of these methods can be used. Either the price can be same once this competitive bidding is done. So we'll see on the other subsequent slide like how this bidding is done. At the moment, we are just looking at the method, how it is being um, how it is being approached, how it is being decided. So it is decided with the help of the institutional player. Institutional players are asked what security they would like to buy and at what price they would like to buy. So this is done. Then next is competitive bidders are the world's largest financial institution. As I said, like the bidding process is done by the big players. Big financial players are the one who are responsible for this whole process of competitive bidding, right? And thereafter, okay, another thing is 80% of all treasury securities are sold to them, and then you can see the 80% of the auction goes through them, right? So now how the pricing will happen? So if you look at this particular paragraph here, the treasury will accept the competitive bids with the highest price and lowest interest rates and will reject other bids, right? So the treasury, when I say highest price and the lowest interest rate, that means you would always like to pay less interest, right? As a issuer of the of a debt instrument, if you are the issuer of debt instrument, you would always like to pay less interest to your investors. You would not like to pay higher interest. So that is why it is written low interest rate and highest price. So how do you calculate the interest rate? Any idea how the interest rate is calculated in case of bond? Anyone? No idea. Okay, no worries. So we'll talk. We'll do this. So so when you talk about interest, interest in the other form is also called coupon payment in bond, right? So that is calculated by the coupon payment divided by your market price. So that is how. So you do need not go into this at the moment because otherwise you will be confused with the whole process. Right now, just focus on the highest price because in bond, in case of debt instrument, the bond price is higher. That means you're going to give less interest to your investors. That is how it is. That's the reason it is written highest price and lower interest rate. So let's come to here. So let's assume that the Federal Reserve wants to issue a T-bill worth $4 billion. Each bid is for minimum one T-bill. Cap is 1 million, and the floor is 985,000 dollars. All competitive tenders are ranked in order of bid yield. Okay, and the lowest competitive bid is accepted first. Okay. So see, this is the price and this is the yield. If you see here on this side, so this is yield is also called return. That you can say interest rate, I can say in other words. So the interest rate is kind of a yield only, and this is the price given. So every bond will have a coupon payment, right? So yield is decided by with the help of the price only. If higher the price, less would be the yield. Okay. So you can say higher the price, then let's just go with one thing only, the price is higher. If higher the price, so those would be accepted first, and accordingly, when the need of the issuer is complete, the last bid would be rejected, or maybe the remaining bids would be rejected. That is how this bidding process is done. Similar like the book building process that we have done. Okay, so let's move on. So now, if you look at the Fed will issue T-bills to client A, B, C, D as they have bid for the highest price and lowest yield. So like here, if you have A, B, C, D, E, so one of them is rejected because their requirement is to pay the lowest yield and the highest price is what they're looking for. So these players are giving more better price compared to this player. This player is just giving this price. If you see other are giving the higher price. So the Fed will be interested in offering this T-bill to these players only who are offering higher price, you can say. So these are the giving the higher price, right? So to whom they are issuing this T-bill, you can say. So the price of security in the auction is set based on whether the auction was a discriminatory or uniform auction process. So as we talked about, a discriminatory and uniform auction process basically means the government of the day can also decide, or the issuer can decide, they're going to use the uniform pricing for all the players no matter what they bid in the auction. So you might have bid higher than your competitor, but there can be a way wherein the issuer decides they're going to price every security similar, and there could be another way of pricing those security that is called discriminatory. Discriminatory means whoever has bid in whatever form, so that is what they're going to receive or pay, right? So that is called discriminatory. So if you have bid higher, then you're going to make high payment or higher payment. If you bid in a lesser amount or in the lowest denomination, then you're going to make that payment only provided you are selected by the issuer. So that is how it is. Then the average yield is calculated. Average yield is basically you take an average of all these four who are selected. If you take an average of all these four, then the average yield would be this. This is just for a knowledge. As such, we're not going to use it anywhere. Just to give you, these are the terms which are used in money market segment. So that's the reason you need to be just aware about these terms. Average yield is to when you take an average of all the players who are selected for this competitive bid, who are going to bid for this T-bill. So their yield average would be calculated, right? And that yield average is then is there written. So if you calculate the average of this four, right? So you will find this is the average. Stop out price is where you have stopped. This is the stop out price. This is also last bid. The last bid price is called stop out price. And stop yield is again it's a corresponding yield. So this is called your stop yield. Tail is the difference between the average and stop yield is called tail. So what is the difference between the stop yield and the average yield? That is called tail. Find any confusion here? Any questions here? Anything not clear? maybe just take maybe if you want to read through, you guys have LMS access, right, everyone?
Yes, sir.
Okay, so in case you want to look back, you can just check from your as an mobile app or whichever app you're using, and maybe if I'm running. Okay, okay, Nishant has, okay, no worries, Nishant, you can leave. Siddharth joined late. Okay, so I hope this process, bidding process is clear because this is really important. This is something which is going to be important. Any confusion how you're calculating this yield, or it is clear? So let me just explain it again for 2 minutes because I don't want anyone is not clear. But I hope you are clear because when the bidding process takes place, it goes through a competitive bidding process. So uh, issuer goes for an auction. An auction happens in a form wherein you reach out to the institutional player, the big financial player, and ask them what quantity they are willing to buy and what price they are willing to buy, right? So one T bill is equal to $10,000 in this particular example that we talked about. No, 1 million. One T bill is maximum of 1 million, and minimum of 985. So when you say cap means the upper price, and when you say floor can be of the below price. It can't be below this, right? It can't be. So this has come out after the bidding only. The bidding has decided as an when you go for a particular bidding, so you need to take this thing into account. What would be the upper price? What would be the lower price? You can't go below it. So bidding has to take place between this only. So there can be player who can say 1 billion, but ideally cap is the upper. So people who are part of the bidding, they give their own price. So this player, client A, says 990 as a price, right? So if 990 is the price, what is the return for the player? It's a 10,000 return. You can imagine very easily. 1 million is the face value. 1 million is the face value, and how much client A is pricing it? 990,000. So return is $10,000, right? So you can calculate the returns as an in terms of percentage form also. So you will divide this 1 million by this 990, so that is the yield that you get. That is the yield you get. Actual price is 1 million. You are pricing 990. You can calculate the return. So that is how the return is calculated. Okay, fine. So similarly, so government would always be interested to buy their securities at a higher price from the investors. So they are only taking those people who are ready to price higher. So they need 4 billion, right? As it is mentioned, there 4 billion. So four people they need. So they have bought. They have decided these are the four players who are going to buy their T bill. Okay, and this is the price they have said. Now it can be either discriminatory, it can be uniform. When I say uniform means if I have decided this is the yield, so maybe this yield is applicable to all, or if I am taking this as a yield, this is applicable to all. So that is a uniform, means the lower yield, especially the lower yield, is applicable to all the players, right? So that is a uniform approach. Discriminatory approach is wherein whatever they have priced, according to that their yield will remain. Okay, so that's it. So probably we can take a 20-minute break right now. Okay, and then we can resume back 20 to 20, right? If you have any question, probably you can ask now, and then we can start at 2:20. Fine.
Okay, sir.
Okay. Okay, so everyone there?
Yes, sir.
Okay, so let's move on to other slide, and let me know guys if in case something is not clear, right? So you can ask me then and there, and even later. It's not only then and there, but you can also ask later. So the important aspect is that we are clear with the things that we are doing with the help of these slides, right? So the basic idea is we are clear with the things that we're discussing, right? So in case you don't find uh, something clear in the first place, then probably you can ask later also. Okay, so let's move on. So this was the example that we were discussing. So these are the terms which are quoted. Average yield. Average yield means finding the average of all the peoples who bought that T-bill. You calculate the average of that yield and you come up with the average yield. Stop out price is the price where the final bid was stopped. So that is the stop out price. So you can see just going back, this is your stop out price, right, where the final bid was stopped. Stop yield, again it's a corresponding yield to the stop out price, so it is called stop yield. Tail is the difference between the average and the stop yield, so that is the tail. So that's the difference between the last yield to the average yield, you can say. Clear? So the competitive bidder specify the amount of security that bidder wants to buy, the price that the bidder wants to pay. He, she automatically pay the defined price, right? And the non-competitive bidders are retail customers. They purchase low volume, not sophisticated enough to submit a bid. The other things, the limit on each non-competitive bid can be set. Direct purchase of treasury security by individuals are limited in many countries. In such cases, they use the service of dealer. So as I said, like in some countries, the direct bidding of securities does not happen to the retail customers. So retail customers are not allowed to participate in the auction process, or rather in the buying of T-bills directly. So they go through dealers in some countries. And in some countries it is allowed, especially in India also it is allowed. You can do the purchase of securities online. For retail customer also this is possible. Okay, so uniform discriminatory, this I've already explained, but again for your information given there, is an auction when all bidders pay the same price, is an auction in which each bidder pays the bid price, right? So bid price means whatever you have, you have bid, so this is what you're going to pay uh, for the particular bid, right? That is how this is discriminatory. You're not going to pay the same price, so it will be different in case of discriminatory bid. Caps and floors are used in a market wherein the price band is to be decided for security. Cap and floor, cap is the maximum price, floor is the minimum price, right? So this is how the cap and floors are there. Cap is as in the 1 million was the maximum price which can be issued, and 985,000 is the minimum price which is given in this particular example that we saw just a while back, right? So this is how these are the terms which are used in investment banking. Cap is the upper price, you can say. Floor is the lower price up till up till what the securities can be issued. So that is how this cap and floor comes into picture. Is the maximum price in which a price band that the security can be issued for, is the minimum price in the price band that the security can be issued for. Okay. Okay, so then the auction lowest competitive bid is accepted first. So here when we looked at this particular site, this was the lowest, in a sense, this was the lowest bid given. The yield is lowest, right? So as you move down, you will find the yield is more. Yield means return. So you can here correspondingly see the returns given on the same slide. Return is also given. So return means your profit. So return is this. Then if you move down, the return is higher. Then you move down, the return is higher. So this is the yield. So yield is less in the first case, and therefore the lowest, you can say, this is your the lowest competitive bid is accepted first. So first is the lowest, and thereafter the subsequent lowest would be coming next. Then the subsequent lowest would be coming next, and then the subsequent lowest would be coming next. So that is how this bidding and auction process will continue as long as all the bids, as in the requirement, is fulfilled. The requirement is a 4 billion in this particular case. So as long as 4 billion requirement is not fulfilled, this process will continue, and all those bids would be taken into consideration. And once the requirement is fulfilled, the process will stop, and all the remaining bids which fall below the last accommodated competitive bid, all other bids would not be considered. That is how this auction process is here. All competitive tenders are ranked in order of the bid yield. So we have already discussed bid yield. In the lowest yield would be first, then the second lowest would be second, third lowest would be third, fourth lowest would be fourth. That is how the bid would be placed in an order, and that is called your auction process in the competitive bidding form in T-bill, right? So stop yield is again it's another term that is used in the process. Stop yield is the highest accepted bid yield. It's called the stop yield. So this we have already discussed here also. Stop out price and stop yield. So it is again given here. Stop yield is the highest accepted bid is called stop yield, where the bid actually stopped. So that is why it is given stop yield. Stop out price is the corresponding price of the stop yield is called stop out price. Competitive versus non-competitive bidders. When you talk about the competitive versus non-competitive bidders, so what is the difference between this? So competitive bidders are the one who are actually bidding for the process. Non-competitive bidders are the one who are not bidding. They are going by the price of the competitor bidders, right? So each competitor bidder pays the price for the security, which is determined by the yield that was bid. The average yield is the average of all accepted competitive bids weighted by the amounts allocated at each yield. All non-competitive bidders pay the average yield. So if you see here, the bidding process was done by the bidding process happened in the competitive bidding. It did not happen in non-competitive bidding process. So all the retail customer, so retail customer go through non-competitive bidding process. They don't go to competitive bidding process. Competitive bidding process is only meant for institutional investors and large financial institutions. They are the part of the competitive bidding process, and the non-competitive bidding process is meant for retail customers, and retail customers bid at the average yield. So they do not have an option to choose in a bid. They do not have an option to choose the price for this particular auction which is taking place. It is more of an average bid is applicable for all of them. So that is how it is there. It is called non-competitive bidders, non-competitive bidding process. Okay, T-bill. So secondary market. Treasury securities have an active and liquid secondary market. The most actively traded issues are called on the run issue, and they have a narrow bid ask spread than the older of the run issue. The role of broker and dealer is performed by the financial institution. So as we discussed in the previous slides also, so the secondary market in TVL is quite an active securities markets from a secondary market point of view. So it is a market where the trading of securities happen. So all these securities which have been auctioned in the primary market will go into secondary market, and will be traded on a regular basis. And these market are facilitated for trading by market dealers. So market dealers are there in the secondary market, and they facilitate the active trading of those securities which have been auctioned in the primary market to the various players, right? So the most actively traded issue are called on the run issue. So the as in the security which are trading actively and which has come in the market recently, that is called on the run issue, right? And they have narrow bid and ask spread. So when I say they have no narrow bid and ask spread, that basically means such securities which have come in the market newly. So given those would not be older in the market, therefore the interest, there would not be any accrued interest on those securities. Accrued interest is something which is the inherent property of the debt instrument. So instrument will incur interest on a regular basis the interest available on a given security. For T-bill there is no interest, but there is a feature of issued a discount and redeemed at par, and therefore if something is redeemed at par, basically that there is a way, that means the interest is being accumulated in a form of the profit which would be redeemed at the end of the maturity, right? So that is how the older issues will be having more, as in the bid ask spread would be wide on those older issues. However, if you talk about from the point of view of newly issued, that difference would not be quite big, due to issue being new in the market, and the interest accrued on those debt instrument would not be much. And that is why the difference between the bid and ask price would be narrow. The role of broker and dealer is performed by the financial institution. As I already mentioned, the role of the role of selling and buying is facilitated with the help of dealers, and who are the financial institutions, big financial institutions. They help in buying and selling of those securities to uh, their clients. Any questions as of now? Anything not clear on any of the terms which we discussed? Okay. So shall we move on?
Yes, sir.
Okay. Okay. Give me a second. Okay. So okay, 1 second. Let us. Okay. So the price of treasury bill. So price of treasury bill is the price that an investor will pay for a particular maturity treasury security, depending upon the investor's required return on it. The price is determined as the present value of the future cash flow to be received. Since the treasury bill does not generate interest payment, the value of it is present value of the par value. Okay, so if you want to know the price of a T-bill, right? And given there is a given the par value would be the par value of your T-bill would be redeemed at maturity, and before that the issue price is the discounted price. So how would you determine the price of a T-bill? So this is price of treasury bill is the price that an investor will pay for a particular maturity treasury security, depending upon the investor's required rate of return. So this becomes the basic uh, way of finding the price. This particular statement, what is the price of treasury bill? So this is how the price of a T-bill is found. So let's look at this particular example. You will be able to relate this statement better. Assume an investor requires a 5% annualized return on a 1-year T-bill with a 1 lakh or 1 lakh euro par value. He will be willing to pay the price. So see, so how would you calculate this? You need how much interest? So that is how to find the exact price of the T-bill. How will you do that? So you know the par value of the T-bill, you know, that's the par value is this, right? Par value is something which is available at redemption. At the maturity is something available. So this is the par value, but you need how much interest? You need 0.5%. So you are going to discount it today. So you need a, you're going to buy this T-bill today, right? So at what price you would like to buy so that you can receive a 5% return? That's basically it means. So you simply, if I show it on Excel, one second, you simply need to, so price of the bill is, and next, one second, let me just increase the font size. Hope you all can see my screen, right?
Yes, sir.
Okay, so required return that you expecting is required rate of return. How much you are expecting? 5%, right? So you write 5% here, and the par value. Let me just first write par value. Par value is 1, right? 1 lakh you can say, or 1 million, whatever. Is it 1 million or 100,000? It is 100,000, 1 lakh you can say, right? So I remove 1 0. Okay, so now you, the required rate is 1%. So what price you want to pay so that you receive the required rate, right? This is what we need to calculate. So you are going to discount it. So how you discount it? You do this, right, and divide by 5. Oh, sorry, this divide by 1.05. Okay, so this is the price that you are ready to pay today for a bill which has par value of 1 lakh euro, and you are expecting a return of 5% on this bill. So you are pricing. So if you want to buy, you would like to buy on this price, right? So this is what is given here, right? 95238. So same is there. So you are discounting the value which you're going to receive over the maturity by dividing the par value by 1.05%. Getting it? Anyone not clear with this example that we discussed? This is a simple example, basic example, right? So you are basically doing a discounting here. So discounting means with the rate that you need. When I say 1.05, it basically means 105 divided by 100. That is to calculate the percentage. Okay. Commercial paper. Let's move on to commercial paper. What are commercial paper? Commercial paper are unsecured promissory notes for a
Sir,
specified.
your screen is not visible.
Oh,
Yeah.
one second. One second. Let me switch. I guess it is not switched. Okay. Now I hope it is visible.
Yes, sir.
So when you look at commercial paper, right? Commercial paper are part of money market instrument or money market. So it is one of the instruments in the money market domain, and this is kind of a promissory note for a specified amount to be paid at a specified date. and it is an unsecured promissory note. Unsecured means it is not backed by any kind of collateral. So no collateral is attached to commercial paper. It is kind of an unsecured promissory note issued to its investors, and it gives a certain amount which needs to be paid back at a specified date. Okay, so this is how the commercial paper is there. Who uses them and why? Commercial paper is the most prevalent form of security in the money market. It is used by large corporations to meet short-term debt requirement. Issued by large corporations, issued a discount and issued for 1 to 270 days. Right. So if you compare the commercial paper versus treasury bills, which are going to give you better yield. Yield is higher for commercial paper compared to T-bills, and that is for the obvious reason, because commercial paper have no collateral backing, as opposed to treasury bills, which have got collateral backing from government. Government issues T-bills, and given it is being issued from the government side, so it is backed by the collateral. There is no likelihood of default from the government side, uh, as opposed to the commercial paper, wherein it is in the form of an unsecured promissory note, which has a mention of a date when the money would be paid back, and what is the equivalent amount which a company is intending to receive on the back of the commercial paper from their investors, right? So this instrument is not available for every corporation. Not every corporation would be able to use this instrument. So only the large corporations, right? So one requirement is the large corporation. At the same time, the large corporation should also have a good credit worthiness, right? So that's the two conditions. So when I say not every corporation can issue it, so one is it is issued by the large corporation, and another is the corporation should have got a good credit worthiness. So finance company and banks, but also include corporation with a strong credit, and even foreign corporation and the sovereign issuer. Mutual fund, and who are the buyers? Mutual funds, banks, insurance company, pension fund, because commercial paper is usually sold in round lots of $100,000. So it is sold in $100,000 round lot to these institutional players, and it is largely to the institutional player only. It is not sold. It is generally it is sold to the retail player also, but it is not directly sold by the issuer. It is sold by the dealers to the retail players. Okay, so hope commercial paper is clear. Commercial paper, if you look at this instrument, it's a unsecured promissory note which is sold to the investors with a promise it will return the money, and it will have mentioned interest paid uh, at the maturity, right? And it has got more return compared to your T-bill, because commercial paper are unsecured form of debt, and therefore the return is expected to be higher compared to T-bill. T-bill is more secure. It can be issued by corporation, it can be issued by your banks, finance company. The condition and eligibility for issuing this promissory note is: one, the company should be a large company; another, the company should have a good credit worthiness. So that is the fundamental conditions of issuing the commercial paper. Right? Clear? Any doubt here?
That even this commercial paper will be a safer form if this large companies are issuing, and at the same time with a strong credit worthiness, then
Okay.
even we can assume that commercial paper is a
Yeah.
safer mode.
Yeah, so it is largely, you can club it under a safe category, because the condition attached is reasonably making it a safer instrument. One, it is coming from a large company; another, the company is also having a good credit worthiness, right? So these two conditions is definitely making it a strong instrument. Not any random company can issue commercial paper, and thereby it can be considered one of the instrument which has a good amount of safety cushion attached to it. It's not the company will default the very next day when they issue the commercial paper, and they need to go through certain level of due diligence before this commercial paper goes out in the market in the hands of the investors. So you can certainly say that way commercial paper has reasonable securities inbuilt in it, but given this is unsecured in nature, so default risks are attached there. You cannot deny that, but it is secured. It's a short-term debt instrument, so it would be a good instrument where corporate and financial company, they do tend to raise money with the help of this kind of instrument for a shorter period of time, usually raised in a lot as mentioned. So $100,000 is one lot at which it is issued, and it is also issued at a higher lot when it goes to the dealer, and that is given there. It is you can see, so financial corporation hold sell two-third of the total commercial paper. So it is the financial corporation who are the one who are selling more of the commercial paper as a trend, and finance companies sell two-third of total commercial paper and sell their issue directly to public, and sell this issue directly to public also, right? So this is one. And if you look at here, the commercial corporations that borrow less frequently, so what they do, sell commercial papers which are known as industrial papers to the paper dealers and charge a markup and sell to the investors. So and the round of lot of paper in dealer is $250,000. So there are another kind of another as in another lot in the commercial paper segment which is of $250,000 worth lot, and this is usually sold first to the dealers, and then dealers sell this lot to their investors, right? So and they charge a fee on it, and then they sell the retailers. So it is not directly sold to the retailers or to the investors, I would say. So it first go to the dealers hand. Dealers again are the big financial players only, so they first receive it. It is called industrial paper. Maybe one of the company wants to roll out their commercial paper, right? So first it will go in the hands of dealers, and dealer will finally roll them out to the investors. Okay, clear? So then the lot size can be increased when it is coming from in the industrial paper form. So then the lot can be of $250,000. Any questions as of now?
Sir, you told that only the big corporates who have good rating can issue commercial paper. So the rating means based on a private rating agency or a government or SEBI fixed that this
Ah.
company's rating should be taken.
Yeah. So the rating should be backed by, as in the rating should be from the rating agencies only. Like in India, we have the rating agencies like CRISIL and ICRA, right? And at the global level, we have rating agencies like Fitch, S&P, and Moody's, right? These are the rating agencies at the global level. So from the US point of view, because the example that we are looking at is from the US point of view, it is talking the USD and all, right? So these rating agencies should be rating a company a good good company, as in the credit worthy company which has no chances of default. So that is how uh, the rating thing comes into picture, right? So rating should be from the credit rating agency, not from the, because even the regulator do not have expertise to find which company is good or which is not good. So it is the rating agencies who assign a certain rating to each company, and that becomes a benchmark to see uh, if a company is doing poorly or is doing fine, or it is really exceedingly doing well, right? So all these parameters can be measured basis the rating agencies are giving those different ratings to the corporations out there in the financial domain, and all the regulators and all would be looking at those ratings which have been assigned by the these rating agencies, and they will certainly be able to understand if the company has got good credit worthiness or not. Like take an example of Vodafone in India, right? It's a very large company, you know. In terms of the market cap, you can certainly say the company is a large cap company. However, if you look at the rating of the company, the rating is not that good, right or wrong? So if they want to go for a commercial paper, they would certainly be not allowed to raise commercial paper by the regulators. Why? Because the rating is not that good, right? So that is the thing. Hope it makes sense.
Yes, sir. And also, sir, the commercial papers are backed by any security, or it is like just like
No, it is not.
unsecured?
Yeah, it is unsecured promissory note only. It's a kind of a note which is given to the investor, but it is not backed by any collateral, and this is unsecured debt, you can say, which the companies are raising. Okay.
Yes.
Okay, let's move on quickly. So the duration can be of 1 to 270 days, as we saw here. It can be issued from 1 day to 270 days, but largely I've seen it is for 45 days and 90 days is more. This is majority of them are either 45 days or for 90 days. Some commercial paper have a maturity of up to 270 days also. So within, you can see, just to give you the tenure of commercial paper. So largely they are issued for 45 or 90 days, but the range can go up to 270 days. Can't be beyond 270 days. If it needs to be, if it needs to go beyond 270 days, then certain level of approval needs to be taken from regulator, that is Securities and Exchange Commission there in US. And if they are fine to extend the time, then it can be accordingly increased. Otherwise, the time limit is already specified and defined, and that needs to be abided by the issuer, and that is how it is. So the most commercial paper is sold in the round lots of $100,000, as we discussed. There's some paper available in lots of 25,000 also. So there is again exception here. So mostly, as we discussed, the range, if one talks about the range, so it is 100,000 is the as in the amount in which a lot is sold to the investors, but it can also be sold in the lot of $25,000, but this is an exception. So, and 250,000 is when the industrial paper goes in the hands of dealer, and dealers then sell it to their retail investors. So that is, or their investors, I would say, not retail investors, so their investor. So that is how the 250,000 is the bigger one. But the most generally, the financial institutions, which the financial institution go with the commercial paper, they sell it in the lot of $100,000. Okay, clear? Any doubt here?
Sir, just one question. What is the return on commercial paper? Like if someone is investing $1 lakh, so what will be the return on $1 lakh?
Yeah, this return feature is something which would be embedded in every commercial paper separately. So it is not a fixed one. I can't say all the commercial paper which would be issued with a fixed rate of return. So it may vary depending upon what company can pay, but it would be higher than T-bill for sure. If T-bill is offering, let's take an example, 5.5 as a return, right? That's a interest, you can say. So the commercial paper will definitely be offering higher than what the T-bill is offering. It may be 6.5 or even more, depending upon company to company and company's appetite of paying that return to their investors. Why it would be higher than what it is in T-bill? As we discussed, this is an instrument which is unsecured one. And if it is unsecured, so the risk is higher. If the more risk are attached to any instrument, so it is the expectation of the investors to receive more return, more of return when the risk is more, right? So that is how this thing is there, right?
Okay, sir.
Okay, let's move on. Certificate of deposit. So what is certificate of deposit? Anyone has heard this term before? Okay. So certificate of deposit as a, if you look at this statement, it looks like some kind of a deposit, some kind of a deposit. So you have a fixed deposit also, and here we're talking about certificate deposit. Again, so this is same as the word says, deposit. So this is a kind of a, it's a short term instrument for a year or so, and the deposit is largely made in a bigger denomination. So if you look at the denomination of deposit, which is under certificate deposit, is largely $1 billion. That's mentioned there in this slide on also. Typically issued with a face value of $1 million, right, in US. So the denomination of certificate deposit is higher, and they are negotiable instrument that can be sold before maturity. So they are tradable instrument, right? These are tradable instrument. These are also traded in secondary market, and this is the beauty of this. However, fixed deposit are not tradable. So once you do a fixed deposit from with your bank, you will have to stay invested in that fixed deposit for that certain number of months, years, or whatever you can call it. Or if you want to break your fixed deposit, then you would be paying a penalty, and that penalty is decided by the bank. So that would be paid by an individual if you want to close your fixed deposit before the actual tenure of the actual tenure of fixed deposit. So here this particular instrument is a tradable. So if you want to sell off your position, or then you can trade this security and you can get the money back. So that's the beauty of this term. And but it is not available in the lower denomination. If you look at the fixed deposit is also available in a lower denomination like 10,000, 20,000, 50,000, whatever the number, right? So minimum is a 10,000, what I understand, if you look at the fixed deposit point of view. But if you look at from the certificate of deposit point of view, then the number is really big. It is $1 billion. So everyone is not be able to go with certificate deposit. So this is how the certificate deposit is there. Usually issued at par and pay interest explicitly. So this is issued at par means whatever you deposit, that is the value that would be written on the certificate deposit, and you would be receiving the interest on the same amount at the end of the maturity. So that's what the certificate deposit, and day count convention method would be used. So day count means there is a method, actual means the number of days, that number, and 360 is the method, one method of day count convention calculation, day count convention. This method would be used for calculating the interest on certificate of deposit for those number of days, months you are holding, you are holding the certificate. Okay, that is how. This is money market security. MMDO is the interest bearing receipt for the funds left with depository institution. So it can be issued by financial institution and also banks. Banks are largely who issue certificate deposit, but there are other financial institutions who are also eligible for issuing the certificate deposit. So amount payable, this is just a formula given there, and I guess I do not need to. Just a basic formula that we have done back also. So it's just the same. Consider a CD with 180 days to maturity that has been issued with a face value of 1 million and coupon rate of 4.5. Right. So this is how you would be calculating the interest receivable on this certificate deposit. So this is the amount, then multiply this, and this is the actual number of days you're holding the certificate of deposit. So this is the number coming up after the calculation. A simple example given just for your understanding. So term deposit and certificate of deposit, you compare. CDs are negotiable. When I say negotiable, that means tradable, right? Term deposits are not tradable. Maturity is only up to 1 year. Maturity is generally more than 1 year. So if you talk about your fixed deposit, the maturity can be higher. Easy to liquidate before maturity, difficult to liquidate before maturity. So in case of term deposit, it is difficult to liquidate in a sense that you're going to pay penalty and fees and all those things on your term deposit. However, when you look at the fixed certificate deposit point of view, these are tradable instruments. So in secondary market, there is enough liquidity available. So if you want to offload a position, offload offloading is quite possible. However, in case of your fixed deposit, you need to pay enough fees and all, then only you would be able to offload your position, or get rid of your position, you can say. Yeah, if you look at certificate deposit, is given traded in secondary market, and offers lesser yield, offers higher yield. So that depends. So it is not term deposit offer higher yield. It depends. Certificate deposit is equally the same instrument, wherein the yield is higher in fixed certificate or deposit. It is not necessarily deposit yield. Certificate deposit would be having lesser yield. It can have even same, or it can be a bit higher also, because the notional amount invested in certificate deposit is higher. Okay. Any questions? Okay, so moving on to next instrument, that is your repurchase agreement. So we discussed partly about repurchase agreement in the previous slide. So what is repurchase agreement? A repurchase agreement is an agreement to buy any security from a seller with the agreement that they will be purchased at some specified date and price in the future. So this is the definition, right? And this is a collateralized loan. If you look at here, repurchase agreement is a fully collateralized loan in which the collateral consists of marketable securities, right? In which collateral consists of marketable securities. So repurchase agreement is a security, or it's an agreement to buy any security from a seller with an agreement that they will be purchased at some specified date and price in the future, right? Or you can say the other way, repurchase agreement is an agreement wherein the seller is selling the security to the buyer with a promise the security will be bought back at a later date, right? So this is what the repurchase agreement is all about. So if you look at here, what is happening, this transaction here, there is a seller, there is a buyer. So seller is selling the security to the buyer, and in return receiving the cash, right? So this is what, if you remember, I guess someone of you were telling me about bank receipt and all. So it was largely for this kind of transactions. So so with the help of a broker, what a bank was doing, bank was buying securities or selling securities. So if they are selling security, then they need cash, and if they are buying security, then they need to pay cash, right? And that was being this whole transaction was being facilitated earlier, back in 1992 or 1990. This sort of a transaction used to be facilitated with the help of brokers only, but now it is not always the broker. It can directly be done by the bank to bank also, and it can be done with the help of dealers, not the ones which are there in the stock market. It is on those who are part of the money markets only. Those dealers can facilitate this kind of a transaction. So when the maturity happens, what will happen? So the cash plus the interest would be given to the seller, sorry, to the buyer, because buyer is the one who has paid you the cash, and the security would be sent back to the seller. So this is important to remember. This is how the transaction will happen. So at the on maturity, what will happen? The cash plus the interest will be given to the buyer, because buyer is the one who has given you the fund. So you have received the fund, you would have used that fund somewhere, maybe you invested it somewhere, right? And therefore you would have accrued interest on that investment, and you need to share the interest to with your buyer. Okay. Any questions here?
So it is more of a like discounting bills of exchange.
Yeah, it is more of a discounting. Yeah, discounting bids. Yeah, right. So discounting, in a sense, there are scenarios wherein banks or institutions into the money market segment, they have a lot of securities with them, right? And those securities have been bought for some reasons. maybe the client require those security in next 1 month or so. A bank has bought those securities beforehand, well before the time. Now bank knows they are not going to use those security before 1 month's time. That is the that's a known fact to the banks. And when bank already knows about the whole thing that this is not going to be used before a month, so they can also go in this kind of a transaction. If there is a player who wants to buy those security, they will sell those security with a promise that they need to be bought back before bought back in the future, especially the date before the client needs it at their end, and in return they get a money, right? So that money can be used by the player for investing somewhere else, and for investment they can also make more. They can make more money, right? So that is how it is there. So the party selling security and agreeing to repurchase it in future, it is called repo, right? So this is the first transaction. This is the first transaction. When a party is selling security and agreeing to repurchase in the future, it is called repo. So this is the first lag, you can say. This is happening. Seller is selling a security, buyer is buying it. Buyer is putting and buyer is giving cash on the back of the security which is bought in the first place. The second lag is when the security is being returned or bought back by the seller. So that is called reverse repo. For the party, on the other hand, of transaction buying security and agreeing to sell it in the future, it is a reverse purchase agreement or reverse repo. Right? So security is bought back, cash is returned with interest. Okay. On default, the lender has a claim on the security. So if you look at this particular deal, it may look very simple on the face of it, but it's not that easy, that simple. Simple when I say in a form. So when a security is sold, so the title of the security changes, so the buyer becomes the real owner of the security, right? So the buyer becomes the real owner of security. That basically means in case the funds are not returned back on time as per the agreement signed, then the security can be liquidated by the buyer to recover the money attached to the security. So that is the whole reason why when the security transaction, this kind of a transaction takes place, the sign or the title of the security actually changes. Clear? So this is one of the collateralized transactions. So you can say earlier the commercial papers, right? And the T-bill. T-bill is secured one, I would say. But you call about as in bank lending, interbank lending, and your commercial paper. All these are unsecured transactions. Collateral is not there. However, if you talk about this one and T-bill, so this is a secure transaction. Secure in the sense the collateral is backed, is there. So that is backing the whole transaction, right? Okay, so let's move on. So depending on the tenure, there are two types of repo agreement. No set maturity date, but renewed each day upon agreement of both the counterparties. So this is called open repo. Open repo is the are those transactions where the maturity date is not mentioned, and therefore the transactions are renewed every day, right? So the every day the transaction is renewed. This kind of a repo transaction is called open repo transaction. On the other hand, there is a term repo also. This kind of a repo transaction has got a time defined in it. So is a repo with a maturity of more than 1 day. So that is called a term repo. So the maturity can range from 1 to 15 days, and at times it can be 1, 3, or 6 months also. A transaction can amount to USD 10 billion. The securities which are sold that can amount to USD 10 million. Okay. So that is how this repo transaction is there. There is no secondary market for repo. So it is not this transaction would be traded somewhere else. No, once the transaction is done, that's the only transaction is there. Further, it can't be used. Further, that security which is sold by the seller should not be consumed anywhere else. The participants to a repo transaction, banks, money market funds, non-financial institutions. Okay, so these are the big players who are part of a repo transactions. Okay, moving on. Repo price. So repo price, this we have already talked about. Just again, the same example is given there. On maturity, how the settlement will take place. So buyer is going to return the security to the seller, and seller is going to return the cash funds which he borrowed in the beginning. Along with the funds, the interest part will also be returned back to the buyer. The repurchase price is higher than the initial sale price, and the difference in the price constitutes the return to the lender. Okay. So the price, the when it is said the repurchase price is higher than the initial sale price, it is higher because the interest is also attached there. Earlier it was only the cash was funded by the buyer in the beginning, but now the buyer is going to receive its own cash. Along with its own cash, there is an interest payment also coming on the back of the fund or the cash supplied by him in the beginning. So therefore, this time the amount would be higher than what he paid to the seller in the beginning. So this is why this is why this it's written there. The constitutes the return to the this price is higher than the initial price, right? The repurchase price is higher than the initial sale price is because of the same reason. Anything not clear? Do let me know. Hope it is clear. So repurchase agreement is again one of your uh, one of money market instrument, right? Which is quite widely used instrument, and big financial institutions they take a position in repo agreement every now and then. It is one of the agreement, one of the instrument you would say, which is widely traded by the big giant players in the money market segment, because it gives a sense of security. It gives a uh, a sense of security and confidence when the transaction happens, because it is backed by a collateral. That is the main reason why it is so widely done by various financial players. Okay, moving on. So amount of repo loan is determined in the following way. Okay, so there is a term called haircut. Okay, so amount of repo loan is determined in the following way. Repo principal, security market value multiplied by 1 minus this the haircut. So security value determined as the current market value of the security. This is the rate of discount of security, term of the securities, and the par value of securities. So if you look at this particular slide, so one thing is there. Repo principal means when you are selling a security to a buyer, buyer is not going to pay the market value of the security. Market value means in market the value of security could be 100 rupees. So you're not going to receive 100 rupees from the buyer. You're going to receive lesser than the buyer. That could be 98, that can be 97, depending upon what is the haircut applied by the buyer. Here, what is the haircut? Any idea? Anyone has heard this term before? If you have heard this haircut as a term in banking somewhere, anyone has worked in loan department somewhere?
I've heard this term, but I forgot.
Okay, no worries. So haircut is okay. Let me just give you a very layman example. Then we will probably understand haircut easily, and that might be something which everyone related easily. So let's take an example wherein you want to take a loan, home loan. Okay. So you reach out to a bank, commercial bank like HDFC Bank, or for that matter, other banks which are there in the market, and you tell them, I need a home loan. I am going to do this deal from the buyer, and the market value of this property is 40 lakh or maybe 50 lakh, whatever you want to quote. So the market value of the property is 50 lakh. So when you reach out to the low to your bank, so bank will say, okay, so you need a home loan, so I can finance the loan, and you need to pay a down payment of 15%, and the rest of the loan amount would be financed by us. That is in case of a loan. It's in case of home loan, right? Bank is not going to finance the entire loan. Bank is just going to finance a large portion of the money, which is the value of the home, and that would be financed by the by bank, and rest of the amount would be paid by you. The reason behind it, why? Because one, when they say 15%, they can finance 90% of it, but they are not going to finance 95%, but they only finance 85%. That means 5% is something which they are applying a haircut, and so that is how the haircut is. Another example we can take to understand it in to understand better, I would say. So let's take you go to your bank, and now you need a loan against property. There is another term like loan against property. Have you heard this term, loan against property
Yes,
ever?
lap mortgage loans,
Yeah, yeah,
Yes, sir.
right. Yeah, right.
secured loans.
Secured loans, you can say, right? So this is a lap. A lap is a short form of a loan against property, right? So you go to your bank and ask them, can you offer me loan against property? I own this property and this is 50 lakh. It is worth 50 lakh in the market. I need a 50 lakh loan. So bank would say, okay, this is 50 lakh property, fine, but I'm not going to pay you. I'm not going to pay you 50 lakh. I'm just going to pay you. Uh, I'm going to pay you only 45 lakhs, or for that matter, 40 lakhs, right? So, or if they say they're going to pay you only 45 lakhs, so that means, and they say no, in their assessment also the value of the property is 50 lakh, right? But they say they're not going to make a full payment of 50 lakh. They're going to make a payment of only 45 lakh. So they're going to apply a certain percentage of haircut on the property value, because now the property is owned by is in the name of bank. As long as you don't repay the complete loan which you have taken from the bank, they're not going to the property will remain in the name of the loan, in the name of the bank, right? So that is how that is how this haircut is applied. So even when the assessment of the bank is same as per you, if you are assessing it is 50 lakh, bank is also assessing it is 50 lakh, then also bank is not going to disperse the same amount to you, because they are going to apply a haircut. Now the question can be, why are they applying haircut, right? So there is a reason behind it. When you say that my property is worth 50 lakh rupees, there is no guarantee the property will remain 50 lakh rupees in future. There is a possibility when the real estate goes down, right, and the value fall further, and it goes down to 45 lakh, right? So it is quite a possibility in real estate sector, wherein uh, they can be boom, they can be sort of a situation where the it's not attractive investment for the investors, and it's not an attractive investor, then for sure the value of the real estate will fall down. And if that happens, the bank tend to lose money, because bank has issued 50 lakh rupees to you, but bank is not able to recover 50 lakh if you default, right? If you have used 50 lakh rupees and the property worth is only 45 lakh rupees, so bank is going to lose 5 lakh rupees for sure. And to have that risk managed, what a bank does, bank applies a certain level of haircut looking at the tenure of the loan. If the loan is for 5 years, they can they try to gauge, they try to establish or gauge the uncertainty which 5 year can bring to them, and that as uncertainty is in the form of a haircut, they apply that percentage deduction. So if I say I'm just going to give you uh, 45 lakh rupees out of the 50 lakh, the 50 lakh of the property worth. So that means how much haircut I'm applying? Am I applying a 10% haircut, right? Right or wrong?
Sir, is it not the same thing? LTV is the same thing as haircut.
Which one?
LTV, loan to value.
Loan to value, yeah. Yeah, you can say loan to value is kind of a haircut only, yeah. So you're finding out what's the value to the loan, right?
Yes, sir.
Yeah, value to the loan you're finding out. So you are assessing the, so it can be, there could be another thing also. Loan to value is can be from the point of view when you are going to the bank. There can be another thing to it. Oh, that
These
is,
are usually applicable for motor loans or something like that. 85% LTV is given, or some like that.
yes, yes, absolutely. So it is a kind of a the two things are there. One is the down payment which comes in, and also the haircut, I would say, when you say loan to value. So the loan to value is not the complete haircut, because at times they are finance 85% only, right?
Yes, sir. Even they do take they take depreciation into consideration. That is
Yes,
why.
yes, yes, right, absolutely. Depreciation and all those factors come into the picture. And then the tenure of the loan also. If the tenure is 1 year, the probably the finance can be a bit more. If the tenure is higher, like 5 years, then the amount would be 85% only, or maybe less. So that is how, because larger the time, the more the depreciation is going to happen, right? So more the depreciation means more the fall in the value. So more in the fall in the value, so more the haircut. So that is how it looked at. So especially for as in the automobile and your uh, as in all the assets which have value depreciation with time, they tend to have more higher haircut compared to the other assets like real estate. Real estate is not something which has a depreciation with time. Rather, it has an uncertainty with market. Market might not do well, and therefore the value may fall down. So it is more linked with the market, not with the value of the asset appreciating with time. So in case of automobile, we know the value will fall down the very next day when your vehicle is out. That's the nature of those investments or those assets, you can say, right? So there the haircut is more, you can say. So loan to value is you can term it that way. And haircut, there is another way, in another word for haircut, that is called valuation percentage. If you heard what is a valuation percentage, so that is also a haircut only. So what percentage of valuation I am taking, so that is called haircut only. Clear?
Yes, sir. Yeah.
Okay. So the function of a broker dealer securities portfolio that cannot be traded but instead must be held as capital to act as a cushion against loss. The definition is given here to margin. The function of a broker dealer securities portfolio that cannot be traded but instead must be held as a capital to act as a cushion against loss. The deduction from the current market value of securities collateral required to the repo transaction is made, which is called a haircut or margin. A repo loan is over collateralized loan, meaning the amount of collateral exceeds the loan principal and the haircut, right? Over collateralized loan, meaning the amount of collateral exceeds the loan principal and the haircut. So this loan which you are giving on the back of the security in the form of repo is an over collateralized. Over collateralized means collateral, the collateral that you are holding is more than the loan that you are offering. So that is how this word over collateralized is written there. So repo loan is over collateralized. Why? Because you are applying a haircut and haircut you applying to factor in the risk attached uh, to fall in value of the security or fall in value of the asset over the years due to market uncertainty. So that is the reason you are applying haircut. So that is what it is given. The haircut or margin offers some protection to the lender in case the borrower goes bankrupt or defaults for some other reasons, right? So this is how this haircut is applied. So if a borrower goes default, it is quite likely the assets which borrower held one point in time, that value is not same. The value of those assets is not same because the borrower has gone bankrupt. So the value of those assets which were held by the borrower can also diminish in its value, can go down drastically. So that could be another reason of having an adequate amount of haircut when this kind of a repo transaction takes place. Hope it makes sense, guys. Okay. Okay, so next moving on. So repo and reverse repo deals. Repo deals are quoted on a yield basis and the rate is quoted on simple interest yield on 360-day rate basis. This is set up upon initiation of transaction and fixed for the term of repo, right? So this is uh, the interest calculation is decided in the beginning only, like what day count convention you would be used. All this is specified in the beginning of the contract itself, right? And repo deals are quoted on yield basis means the what would be the interest on a daily basis that would be calculated on the repo transaction. When this is first, there are two pictures given on this slide which are giving you two legs of the repo transaction. One leg is showing when the cash is borrowed against the collateral or security, you can say, and next is shown when the cash is returned with interest and the security is coming back to the seller. So that is how these two legs are complete now. So these two transactions happen that way only. Reverse repo. In reverse repo transaction, the reverse in payment is calculated. Reverse principal plus interest, right? So this is the formula given. Very simple one. Nothing such to same thing is there. Reverse principal is written there, and your interest is given, the time and all. So if you calculate with this, then you will find the principal plus interest. No need to remember it because it's a very simple. No one is going to ask you the formula for reverse repo. But just for good to know point of view, because you should be knowing what we are doing, how we coming to this. This is definition, the difference between the two. What is the difference between reverse repo and the repo? Buyer of a security, buyer of the security has the right to surrender the security at a future date, right? So this is what is from the point of view of buyer. When the reverse repo happens, buyer returns the same security which he bought it in the beginning to the seller. So this is what it is written. Buyer of the security has the right to surrender the security at a future date, and the receiver of the funds is the lender, right? So lender is the one who is giving the funds in the first place. So this is about the first leg. You can say this point is about first leg. This point is for second leg point of view. Seller of the security has a right to repurchase the security at the future date, right? Same thing. Buyer has a right to surrender, then the seller has the right to buy it. Receiver of funds is the borrower. That's how the difference is given there. So what are the pros and cons of money market? Uh, Money market, that's given the advantages in the form of advantages, disadvantages: higher rate of interest, low risk, easy access, right? High balance requirement, limited number of withdrawals and transfers, interest rate fluctuations, and other fees. So these are the disadvantages associated with money market, uh, and the advantages and the disadvantages, you can say. Fine. Anything not clear? I think these terms are easy to understand. I don't think need to give any explanation. Anyone not clear, then let me know. I hope these terms are clear, right? Because we have already sort of covered them as per the discussion that we have done so far. Okay, fine. I take it no. Okay. So, what are broad differences between capital market and money market? You already know them. It has been put into tabular form so that you have these points readily available to you when you need to tell it to someone. That's the only reason why we have put it in this format. The only reason is you probably have readily available in your mind when you need to tell someone the difference between the capital market and the money market. So the capital market, you know, it is for a longer uh, maturity or longer horizon of maturity, so more than a year. Here, when you talk about the money market instruments, so money market instruments have maturity of less than a year. The risk is more and varied because the longer the maturity, longer the risk. We know they are less risky. Money market are less risky compared to capital market due to the shorter duration, and there are transactions happening in money market segment also, which are backed by collateral, so it is less risky. You can say deals in long-term capital, deals in short-term capital, understandable. Instruments include shares, bonds. Instruments include T-bills, certificate deposit, repo, right, and all. So this is all we have got in money market. There is one more instrument which I just want to add on to the list, which is probably not there in this particular explanation. That is called bankers acceptance. Bankers acceptance, or you can say bill of exchange. Anyone has heard this term?
Yes, sir, I've heard this term. Bill of exchange. It's like
Yeah, right. So it is also bankers acceptance, you can say letter or a bill of exchange, more or less the same thing, used with two different terms or two different words, I would say. It is largely the same thing. So bankers acceptance is applicable when you are doing a deal on a credit basis. And if you look at your import and export happening, import and export largely happens on credit only. So first the goods would be delivered, and once the goods are delivered, those are paid back in maybe 2 months time or 3 months time and all that, right? So that is how this whole uh, deal happens, especially the import and export I'm talking about. So when the import and export takes place, so what is happened? So in that situation, bill of exchange is an instrument which is exchanged with the help of the bank of the client. So let's take an example. I'm client A, and there is a client B, right? So client A is an exporter. I'm exporting goods to client B. Client B is based out of another country. Let's take Dubai, right? So once I we have agreed for a certain as in have you agreed for a goods, or maybe you can talk about any other garment business or whatever you want to call about, right? So this is a deal which has been signed between the client A and client B. Now client A needs to deliver this consignment to client B, and once the consignment reaches client B, there remains there remains a situation wherein the client A might fear the client B will obligate his obligation or not. That might be a fear which client A might have in his mind. And to mitigate this fear, what could happen? There is a banker acceptance or bill of exchange letter which is created by the client B's bank. So client B's bank would be involved. Client B's bank will give a banker acceptance letter to client A, and that will be a tradable instrument that will trade for trade that is tradable in a period of 30 for a period of 30 to 180 days depending upon the number mentioned there. So basically when I say it's tradable for 30 to 30 to 180 days, it means your payment is going to come in those number of days. Your actual payment on the back of that letter or on the back of that bill which has been exchanged on behalf of client B by the bank of B. So that is going to the entire payment will come on those number of days which is mentioned there, 30 or one up to 180 days. So that is the maximum time I'm saying. It can take about 30 days or it can extend up to 180 days. So within this time frame, the amount which is due to client B should come to you. So this is kind of a guarantee coming from client B's bank. Like my client is not going to run away from his obligation. And to back up this promise or this deal, I'm giving you this letter to you. So the client A can trust bank because banks are credible enough to be trusted, right? Banks are credible enough to be trusted in the financial market because banks are just not dealing in one market only. They have got presence across the globe. So one bank would be present in India and also be present in other regions of different countries, right? So that is how the banks have got their presence. So bank when comes into picture, banks sort of gives a trust to the party which is there in other country, and this trust is enough because this instrument which comes in the hand of client A is also called a tradable instrument. So when I say tradable, so it can be traded on discount. So if you're going to receive maybe 1 lakh rupees on the back of the deal that you have signed with client B. So if you need money very quickly right now, so probably it can be traded at discount. Uh, let's suppose 95,000 is the discount value. So you receive only 95,000 of the 1 lakh which is there in the contract. If you want to wait for 90 days, which is the period of this the entire period for when you are about to receive the cash value. So you will be receiving the entire 1 lakh rupees. However, if you need money